Welcome, everyone, to Trading for Life, your go-to destination for mastering the markets, building financial freedom, and transforming your trading journey into a lifelong skill set. Today, we're diving into one of the most respected and time-tested resources in the world of market analysis, the audiobook. Technical Analysis Explained by Martin Pring. This isn't just another trading book, it's a foundational guide that has educated generations of traders and investors. Whether you're a beginner trying to make sense of charts or a seasoned trader looking to refine your edge, this audiobook offers deep insights into price action, chart patterns, indicators, and the psychology that moves markets. So who should listen to this audiobook and why? New traders. If you're just starting out and feel overwhelmed by technical jargon, this book will break down the core principles of technical analysis in a way that's accessible and practical. Intermediate traders. If you've been dabbling in the markets and want to start making data-driven decisions, Pring's approach can help you build a structured, disciplined strategy. Long-term investors. Even if you're not trading daily, understanding technical trends can improve your timing and risk management. Anyone serious about mastering the markets, this book is a masterclass in interpreting price movements, cycles, and the psychology of crowd behavior. Martin Pring doesn't just teach you what to look at. He teaches you how to think like a trader. So grab your headphones, settle in, and prepare to level up your market IQ with Technical Analysis Explained. This is Trading for Life, and your education starts now.
Technical Analysis Explained, 5th edition by Martin Pring. Preface: there is no reason why anyone cannot make a substantial amount of money in the financial markets, but there are many reasons why many people will not. As with most endeavors in life, the key to success is knowledge and action. This book has been written in an attempt to shed some light on the internal workings of the markets and to help expand the knowledge component, leaving the action to the patience, discipline, and objectivity of the individual investor. The mid to late 1980s saw the expansion of investment and trading opportunities to a global scale in terms of both the cash and the futures markets. In the 1990s, innovations in the communications industry enabled anyone to plot data on an intraday basis for relatively little cost. Today, numerous charting sites have sprung up on the internet, so now virtually anyone has the ability to practice technical analysis. Indeed, the technology of teaching technical analysis has progressed since the first edition of this book in 1979. We pioneered the teaching of the subject in video format in the mid-1980s. But I'll venture to guess that technological progress and the acceptance of new media formats will mean that e-book sales of this edition will outstrip traditional sales of the physical book before it runs its course. Already, the written word is in competition with audiovisual presentations, such as my recently introduced online interactive technical analysis video course at Pringcom. Others are sure to follow. As a consequence of the technological revolution, time horizons have been greatly shortened. I am not sure that this is a good thing because short-term trends experience more random noise than longer-term ones. This means that the technical indicators, while still the most effective tool, are not generally as successful when applied to longer-term trends. The 5th edition of Technical Analysis Explained has been expanded and totally revised to keep abreast of many of these changes, and to include some technical innovations and evolvement in my own thinking since the publication of the 4th edition. Nearly every chapter has been thoroughly reworked and expanded. In the interest of efficiency, some have been dropped and others substituted. Considerable attention continues to be focused on the U.S. equity market, but many of the marketplace examples feature international stock indexes, currencies, commodities, and precious metals. Special chapters also feature technical analysis of the credit markets and global equities. Our focus has also been expanded to include analysis of the secular, or very long-term, trends of stocks, bonds, and commodities. In most cases, the marketplace examples have been updated, but some older ones from previous editions have been left in deliberately to give the book some historical perspective. These historical examples also underscore the point that nothing has really changed in the last 100 years. The same tried and true principles are as relevant today as they always were. I have no doubt whatsoever that this will continue to be so in the future. Thus, technical analysis could be applied in New York in 1850 in Tokyo in 1950, and in Moscow in 2150. This is true because price action in financial markets is a reflection of human nature, and human nature remains more or less constant. Technical principles can also be applied to any freely traded entity in any time frame. A trend reversal signal on a 5-minute bar chart is based on the same indicators as one on a monthly chart. Only the significance is different. Shorter time frames reflect shorter trends and are, therefore, less significant. The chronological sequence of some of the opening chapters differs from previous editions. In Martin Pring on Price Patterns, McGraw-Hill, 2005, I approached the subject by first describing the building blocks of price formations, peak and trough analysis, support and resistance, trend lines, and volume characteristics. This same logical sequence has been applied here, so when anyone proceeds to the explanation of price patterns, they will be in a far stronger position to understand how these formations are constructed and interpreted. 2 new chapters have been added in this edition. One on secular trends has already been referred to. The secular, or very long-term trend is the granddaddy of them all and exists for each of the 3 primary asset classes: bonds, stocks, and commodities. The more I study markets, the more I become impressed with the fact that the direction of the secular trend influences the characteristics of the trends that fall directly below it. In secular uptrends, primary bull business cycle associated trends generally have greater magnitude and duration than do bear markets, and vice versa. Understanding the characteristics of secular trends and how their reversal might be identified is therefore a key objective of Chapter 23. Our second new chapter discusses indicators and relationships that measure confidence in the U.S. equity market. The discussion points out that market reversals are often signaled ahead of time in a subtle way by changes in relationships that monitor investor confidence. Other important items that have been inserted in existing chapters include my special K indicator. This momentum series is calculated from the summed cyclicality of the short-term, intermediate term, and long-term no-sure-thing KSD, and offers a series that on most occasions peaks and troughs simultaneously with the price series it is monitoring. Another feature of the 5th edition is the inclusion of many exchange-traded funds ETFs as illustrative examples. These innovative products now allow investors and traders to purchase a basket of stocks or bonds reflecting popular indexes, sectors, or countries. And this is just the beginning. Indeed, active ETFs, such as the Pring-Turner Business Cycle ETF symbol DBIZ, allow investors to participate in various strategies, such as the approach discussed in Chapter 2. The introduction and widespread acceptance of ETFs make it so much easier for investors to gain exposure to individual country equity markets, credit market instruments, practice sector rotation, purchase inverse funds if they believe prices are headed lower, etc. In addition, recent years have seen the launch of exchange-traded notes, which allow the purchase of selected commodities. However, investors need to be careful to check tax implications and to make sure that swings in carrying costs in the futures markets truly reflect the ups and downs of the commodities in question. Since the 1970s, the time horizon of virtually all market participants has shrunk considerably. As a result, technical analysis has become very popular for implementing short-term timing strategies. This use may lead to great disappointment. In my experience, there is a rough correlation between the reliability of the technical indicators and the time span being monitored. This is why most of the discussion here has been oriented toward intermediate-term and long-term trends. Even short-term traders with a 1 to 3 week time horizon need to have some understanding of the direction and maturity of the main or primary trend. This is because mistakes are usually made by taking on positions that go against the direction of the main trend. If a whipsaw false signal is going to develop, it will usually arise from a contra-trend signal. Think of it as paddling upstream against the current. It can be done, but with great difficulty. Far better to have the current behind you. To be successful, Technical analysis should be regarded as the art of assessing the technical position of a particular security with the aid of several scientifically researched indicators. Although many of the mechanistic techniques described in this book offer reliable indications of changing market conditions, all suffer from the common characteristic that they can, and occasionally do, fail to operate satisfactorily. This attribute presents no problem to the consciously disciplined investor or trader, since a good working knowledge of the principles underlying major price movements in financial markets and a balanced view of the overall technical position offer a superior framework within which to operate. There is, after all, no substitute for independent thought. The action of the technical indicators illustrates the underlying characteristics of any market, and it is up to the analyst to put the pieces of the jigsaw puzzle together and develop a working hypothesis. The task is by no means easy, as initial success can lead to overconfidence and arrogance. Charles H. Dow, the father of technical analysis, once wrote words to the effect that pride of opinion caused the downfall of more men on Wall Street than all the other opinions put together. This is true because markets are essentially a reflection of people in action. Normally, such activity develops on a reasonably predictable path. Since people can, and do, change their minds, price trends in the market can deviate unexpectedly from their anticipated course. To avoid serious trouble, investors, and especially traders, must adjust their attitudes as changes in the technical position emerge. That does not mean that one should turn negative because prices are falling. Rather, one should take a bearish tack because the evidence has also done so. In addition to pecuniary rewards, a study of the market can reveal much about human nature, both from observing other people in action and from the aspect of self-development. As investors react to the constant struggle through which the market will undoubtedly put them, they will also learn a little about their own makeup. Washington Irving might well have been referring to this challenge of the markets when he wrote, "Little minds are taxed and subdued by misfortune, but great minds rise above it." Martin J. Pring, October 2013. Part 1. Trend Determining Techniques. Chapter 1. The Definition and Interaction of Trends. In the introduction, technical analysis was defined as the art of identifying trend changes at an early stage and to maintain an investment or trading posture until the weight of the evidence indicates that the trend has reversed. In order to identify a trend reversal, we must first know what that trend is. This chapter explains and categorizes the principal trends and concludes with a discussion of one of the basic building blocks of technical analysis, peak and trough progression. This technique is arguably the simplest of trend-determining techniques, but in my book, certainly one of the most effective. Time frames. We have already established the link between psychology and prices. It is also a fact that human nature, psychology, is more or less constant. This means that the principles of technical analysis can be applied to any time frame, from 1-minute bars to weekly and monthly charts. The interpretation is identical. The only difference is that the battle between buyers and sellers is much larger on the monthly charts than on the intraday ones. This means that such trend reversal signals are far more significant. As we proceed, it will be evident that this book contains a huge variety of examples featuring many different time frames. For the purpose of interpretation, the time frame really doesn't matter. It's the character of the pattern that does. For example, if you are a long-term trader and see a particular example featured on a 10-minute bar chart, the principles of interpretation are the same when applied to a weekly chart. A long-term investor would never initiate an investment based on a 10-minute chart, but can and should take action when that same type of technical evidence appears on a weekly or monthly one, and vice versa. 3 important trends. A trend is a period in which a price moves in an irregular but persistent direction. It may also be described as a time measurement of the direction in price levels covering different time spans. There are many different classifications of trends in technical analysis. It is useful to examine the more common ones, since such an understanding will give us perspective on the significance of specific technical events. The 3 most widely followed trends are primary, intermediate, and short-term. Whenever we talk of any specific category of trend lasting for such and such a time period, please remember that the description offered is a rough guide encompassing most, but not all, of the possible durations for that particular type. Some specific trends will last longer and others for less time. Primary. The primary trend generally lasts between 9 months and 2 years and is a reflection of investors' attitudes toward unfolding fundamentals in the business cycle. The business cycle extends statistically from trough to trough for approximately 3.6 years, so it follows that rising and falling primary trends, bull and bear markets last for 1 to 2 years. Since building up takes longer than tearing down, bull markets generally last longer than bear markets. The direction of the secular or very long-term trend will also affect the magnitude and duration of a primary trend. Those that move in the direction of the secular trend will generally experience greater magnitude and duration than those that move in the opposite direction. The characteristics of secular trends are discussed later in this chapter, and more fully in Chapter 23. The primary trend cycle is operative for bonds, equities, and commodities. Primary trends also apply to currencies, but since they reflect investors' attitudes toward the interrelationship of two different economies, analysis of currency relationships does not fit neatly into the business cycle approach discussed in Chapter 2. The primary trend is illustrated in Figure 1.1 by the thickest line. In an idealized situation, the primary uptrend bull market is the same size as the primary downtrend bear market. But in reality, of course, their magnitudes are different. Because it is very important to position both short-term trades and long-term investments in the direction of the main trend, a significant part of this book is concerned with identifying reversals in the primary trend. Intermediate. Anyone who has looked at prices on a chart will notice that they do not move in a straight line. A primary upswing is interrupted by several reactions along the way. These countercyclical trends within the confines of a primary bull market are known as intermediate price movements. They last anywhere from 6 weeks to as long as 9 months, sometimes even longer, but rarely shorter. Countercyclical intermediate trends are typically very deceptive, often being founded on very believable but false assumptions. For example, an intermediate rally during a bear market in equities may very well be founded on a couple of unexpectedly positive economic numbers, which make it appear that the economy will avoid that much-feared recession. When subsequent numbers are reported and found to be wanting, the bear market resumes. Intermediate-term trends of the stock market are examined in greater detail in Chapter 4 and are shown as a thin, solid line in Figure 1.1. It is important to have an idea of the direction and maturity of the primary trend, but an analysis of intermediate trends is also helpful for improving success rates in trading, as well as for determining when the primary movement may have run its course. Short-term trends. Short-term trends typically last 3 to 6 weeks, sometimes shorter and sometimes longer. They interrupt the course of the intermediate cycle, just as the intermediate-term trend interrupts primary price movements. Short-term trends are shown in the market cycle model, Figure 1.1, as a dashed line. They are usually influenced by random news events and are far more difficult to identify than their intermediate or primary counterparts. Major technical principle. As a general rule, the longer the time span of a trend, the easier it is to identify. The shorter the time span, the more random it is likely to be. The market cycle model. By now, it is apparent that the price level of any market is influenced simultaneously by several different trends, and it is important to understand which type is being monitored. For example, if a reversal in a short-term trend has just taken place, a much smaller price movement may be expected than if the primary trend had reversed. Long-term investors are principally concerned with the direction of the primary trend, and thus, it is important for them to have some perspective on the maturity of the prevailing bull or bear market. However, long-term investors must also be aware of intermediate and, to a lesser extent, short-term trends. This is because an important step in the analysis is an examination and understanding of the relationship between short and intermediate-term trends, and how they affect the primary trend. Also, if it is concluded that the long-term trend has just reversed to the upside, it may pay to wait before committing capital because the short-term trend could be overextended on the upside. Ignoring the position of the short-term trend could therefore prove costly at the margin. Short-term traders are principally concerned with smaller movements in price, but they also need to know the direction of the intermediate and primary trends. This is because of the following principle. Major technical principle: surprises occur in the direction of the main trend, i.e., on the upside in a bull market and on the downside in a bear market. In other words, rising short-term trends within the confines of a bull market are likely to be much greater in magnitude than short-term downtrends, and vice versa. Losses usually develop because the trader is in a countercyclical position against the main trend. In effect, all market participants need to have some kind of working knowledge of all three trends, although the emphasis will depend on whether their orientation comes from an investment or a short-term trading perspective. Major technical principle: the direction of the primary trend will affect the character of intermediate and short-term trends. Two supplementary trends. Intraday. The post-1990 development of real-time trading enabled market participants to identify hourly and even tick-by-tick price movements. The principles of technical analysis apply equally to these very short-term movements and are just as valid. There are two main differences. First, reversals in the intraday charts only have a very short-term implication and are not significant for longer-term price reversals. Second, extremely short-term price movements are much more influenced by psychology and instant reaction to news events than are longer-term ones. Decisions, therefore, have a tendency to be emotional, knee-jerk reactions. Intraday price action is also more susceptible to manipulation. As a consequence, price data used in very short-term charts are much more erratic and generally less reliable than those that appear in the longer-term charts. The secular trend. The primary trend consists of several intermediate cycles, but the secular or very long-term trend is constructed from a number of primary trends. This supercycle, or long wave, extends over a substantially greater period, usually lasting well over 10 years and often as long as 25 years, though most average between 15 and 20 years. It is discussed at great length in Chapter 23. A diagram of the interrelationship between a secular and a primary trend is shown in Figure 1.2. It is certainly very helpful to understand the direction of the secular trend. Just as the primary trend influences the magnitude of the intermediate term rally relative to the countercyclical reaction, so too does the secular trend influence the magnitude and duration of a primary trend rally or reaction. For example, in a rising secular trend, primary bull markets will be of greater magnitude than primary bear markets. In a secular downtrend, bear markets will be more powerful and will take longer to unfold than bull markets. It is certainly true to say that long-term surprises will develop in the direction of the secular trend. Bonds and commodities are also subject to secular trends, and these feed back into each other as well as into equities. I will have much more to say on this subject later. Peak and trough progression. Earlier, we established that technical analysis is the art of identifying a price trend reversal based on the weight of the evidence. As in a court of law, a trend is presumed innocent until proven guilty. The evidence is the objective element in technical analysis. It consists of a series of scientifically derived indicators or techniques that work well most of the time in the trend identification process. The art consists of combining these indicators into an overall picture and recognizing when that picture resembles a market peak or trough. Widespread use of computers has led to the development of some very sophisticated trend identification techniques. Some of them work reasonably well, but most do not. The continual search for the Holy Grail, or perfect indicator, will undoubtedly continue, but it is unlikely that such a technique will ever be developed. Even if it were, news of its discovery would soon be disseminated, and the indicator would gradually be discounted. It is as well to remember that prices are determined by swings in crowd psychology. People can and do change their minds, and so do markets. Major technical principle: never go for perfection. Always shoot for consistency. In the quest for sophisticated mathematical techniques, some of the simplest and most basic techniques of technical analysis are often overlooked. Arguably, the simplest technique of all, and one that has been underused, is peak and trough progression. See Chart 1.1. This principle reflects Charles Dow's original observation that a rising market moves in a series of waves, with each rally and reaction being higher than its predecessor. When the series of rising peaks and troughs is interrupted, a trend reversal is signaled. To explain this approach, Dow used an analogy with the ripple effect of waves on a seashore. He pointed out that just as it was possible for someone on the beach to identify the turning of the tide by a reversal of receding wave action at low tide, so too could the same objective be achieved in the market by observing the price action. In Figure 1.3, the price has been advancing in a series of waves, with each peak and trough reaching higher than its predecessor. Then, for the first time, a rally fails to move to a new high, and the subsequent reaction pushes it below the previous trough. This occurs at point X and gives a signal that the trend has reversed. Figure 1.4 shows a similar situation, but this time, the trend reversal is from a downtrend to an uptrend. The idea of the interruption of a series of peaks and troughs is the basic building block for both Dow Theory, Chapter 3, and Price Pattern Analysis, Chapter 8. For example, if it takes 2 to 3 weeks to complete each wave in a series of rallies and reactions, the trend reversal will be an intermediate one, since intermediate price movements consist of a series of short-term 2 circumflex to 6-week fluctuations. Similarly, the interruption of a series of falling intermediate peaks and troughs by a rising one signals a reversal from a primary bear to a primary bull market. A peak and trough dilemma. Occasionally, peak and trough progression becomes more complicated than the examples shown in Figures 1.3 and 1.4. In Figure 1.5, Example A, the market has been advancing in a series of rising peaks and troughs, but following the highest peak, the price declines at point X to a level that is below the previous low. At this juncture, the series of rising troughs has been broken, but not the series of rising peaks. In other words, at point X, only half a signal has been generated. The complete signal of a reversal of both rising peaks and troughs arises at point Y, when the price slips below the level previously reached at point X. At point X, there is quite a dilemma because the trend should still be classified as positive. And yet, the very fact that the series of rising troughs has been interrupted indicates underlying technical weakness. On the one hand, we are presented with half a bearish signal, while on the other hand, waiting for point Y would mean giving up a substantial amount of the profits earned during the bull market. The dilemma is probably best dealt with by referring back to the second half of the definition of technical analysis given at the beginning of this chapter, and riding that trend until the weight of the evidence proves that it has been reversed. In this case, if the weight of the evidence from other technical indicators, such as moving averages, volume, momentum, and breadth, discussed in later chapters, overwhelmingly indicates a trend reversal, it is probably safe to anticipate a change in trend, even though peak and trough progression has not completely confirmed the situation. It is still a wise policy, though, to view this signal with some degree of skepticism, until the reversal is confirmed by an interruption in both series of rising peaks as well as troughs. Figure 1.5, Example B, shows this type of situation for a reversal from a bear to bull trend. The same principles of interpretation apply at point X as in Figure 1.5, Example A. Occasionally, determining what constitutes a rally or reaction becomes a subjective process. One way around this problem is to choose an objective measure, such as categorizing rallies greater than, say, 5%. This can be a tedious process, but some software programs, such as Metastock with its zigzag tool, enable the user to establish such benchmarks almost instantly in graphic format. What constitutes a legitimate peak and trough? Most of the time, The various rallies and reactions are self-evident, so it is easy to determine that these turning points are legitimate peaks and troughs. Technical lore has it that a reaction to the prevailing trend should retrace between 1/3 and 2/3 of the previous move. Thus, in Figure 1.6, the first rally from the trough low to the subsequent peak is 100%. The ensuing reaction appears to be just over half, or a 50% retracement of the previous move. Occasionally, the retracement can reach 100%. Technical analysis is far from precise, but if a retracement move is a good deal less than the minimum 1/3, then the peak or trough in question is held to be suspect. Sometimes, though, it takes the form of a line or trading range. The depth of the trading range can fall short of the minimum approximate 1/3 retracement requirement, and in such instances, the correction qualifies more on the basis of time than on magnitude. A rule of thumb might be for the correction to last between 1/3 and 2/3 of the time taken to achieve the previous advance or decline. In Figure 1.7, the time distance between the low and the high for the move represents 100%. The consolidation prior to the breakout should constitute roughly 2/3, or 66%, of the time taken to achieve the advance, ample time to consolidate gains and move on to a new high. These are only rough guidelines, and in the final analysis, it is a judgment call based on experience, common sense, a bit of intuition, and perhaps most important of all, a review of other factors such as volume, support and resistance principles, etc. The words common sense have been italicized because the charts should always be interpreted with a bit of poetic license. For example, the rule states that a 1/3 retracement is required for a legitimate turning point, but it turns out to be 32%. If other factors suggest the move qualifies as a valid retracement, always take the common sense interpretation over the strict rules-based one. That is why we should regard technical analysis as both a science and an art. We have mainly been studying these concepts in a rising trend. However, the principles work exactly the same in a declining trend, in that rallies should retrace 1/3 to 2/3 of the previous decline. It is also important to categorize what kind of trend is being monitored. Obviously, a reversal derived from a series of rallies and reactions, each lasting, say, 2 to 3 weeks, would be an intermediate reversal. This is because the swings would be short-term in nature. On the other hand, peak and trough reversals that develop in intraday charts are likely to have significance over a much shorter period. How short would depend on whether the swings were a reflection of hourly or, say, 5-minute bars. Summary 1. A number of different trends simultaneously influence the price level of any market. 2. The three most important trends are primary, intermediate, and short-term. 3. The principles of technical analysis apply to intraday trends, but since they are more random in nature, the analysis is generally less reliable than that for longer-term trends. 4. Very long-term or secular trends influence the magnitude of primary bull and bear markets. 5. Peak and trough progression is the most basic trend identification technique and is a basic building block of technical analysis. 6. As a general rule, in order to qualify as a new legitimate peak or trough, the price should retrace between 1/3 and 2/3 of the previous move. 7. Lines or consolidations also qualify as peaks and troughs where they form between 1/3 and 2/3 of the time taken to produce the previous advance or decline. Chapter 2. Financial Markets and the Business Cycle. Introduction. Our principal objective here is to explain the benefits of the technical approach, but it is also important to understand that primary trends of stocks, bonds, and commodities are determined by the attitude of investors toward unfolding events in the business cycle. Each market has a tendency to peak and trough at different points during the cycle in a consistent, chronological manner. An understanding of the interrelationship of credit, equity, and commodity markets provides a useful framework for identifying major reversals in each. The discounting mechanism of financial markets. The primary trend of all financial markets is essentially determined by investors' expectations of movements in the economy. the effect those changes are likely to have on the price of the asset in which a specific financial market deals, and the psychological attitude of investors to these fundamental factors. Market participants typically anticipate future economic and financial developments and take action by buying or selling the appropriate assets, with the result that a market normally reaches a major turning point well ahead of the actual development. Expectations of an expanding level of economic activity are usually favorable for stock prices. Anticipation of a weak economy is bullish for bond prices, and prospects for capacity constraints offer a favorable tailwind for industrial commodity prices. These three markets often move in different directions simultaneously because they are discounting different things. An economy is rarely stable. Generally, it is either expanding or contracting. As a result, financial markets are in a continual state of flux. A hypothetical economy, as shown in Figure 2.1, revolves around a point of balance known as equilibrium. Roughly speaking, equilibrium can be thought of as a period of zero growth in which business activity is neither expanding nor contracting. In practice, this state of affairs is rarely, if ever, attained, since an economy as a whole possesses tremendous momentum in either the expansionary or the contractionary phase, so that the turnaround rarely occurs at an equilibrium level. In any event, the economy consists of a host of individual sectors, many of which are operating in different directions at the same time. Thus, at the beginning of the business cycle, leading economic indicators such as housing starts might be rising, while lagging indicators such as capital spending could be falling. Market participants in financial markets are not concerned with periods of extended stability or equilibrium, for such environments do not produce volatile price swings and opportunities to make quick profits. The ever-changing character of the economic cycle creates tremendous opportunities for investors and traders, because it means that different industries are experiencing different economic conditions simultaneously. Since housing leads the economy, housing stocks do well at the start of the recovery, when capital-intensive stocks such as steels tend to underperform. Later in the cycle, the tables are turned and housing peaks first, usually in an absolute sense, but occasionally as measured by its relative performance to a market average such as the S&P composite. Different equity sectors discounting their specific area of the economy give rise to the sector rotation process, which is discussed at length in Chapter 22. Since the financial markets lead the economy, it follows that the greatest profits can be made just before the point of maximum economic distortion, or disequilibrium. Once investors realize that an economy is changing direction and returning toward the equilibrium level, they discount this development by buying or selling the appropriate asset. Obviously, the more dislocated and volatile an economy becomes, the greater is the potential, not only for a return toward the equilibrium level, but also for a strong swing well beyond it to the other extreme. Under such conditions, the possibilities for making money in financial markets are greater because they, too, will normally become subject to wider price fluctuations. Two of the wildest post-World War Roman II economic swings, 1973, 1974, and 2007, 2008, certainly provided traders and investors with a roller coaster ride. With great profit possibilities, were they able to identify the two respective bear market lows. Market movements and the business cycle. The major movements of interest rates, equities, and commodity prices are related to changes in the level of business activity. Please note that the term commodity prices refers to industrial prices that are sensitive to business conditions, as opposed to weather-driven commodities such as grains. Figure 2.2 represents a business cycle, which typically has a life of between 3 and 5 years between troughs. The horizontal line reflects a level of zero growth, above which are periods of expansion, and below which are periods of contraction. After the peak is experienced, the economy continues to grow, but at a declining rate, until the line crosses below the equilibrium level and contraction in economic activity takes place. The arrows in Figure 2.2 show the idealized peaks and troughs of the financial markets as they relate to the business cycle. Periods of expansion generally last longer than periods of contraction because it takes longer to build something up than to tear it down. For this reason, bull markets for equities generally last longer than bear markets do. The same could be said for interest rates and commodities, but in all cases, the magnitude and duration of primary trends depend on the direction of the secular trend, as discussed in chapters 1 and 23. Figure 2.3 shows the hypothetical trajectories of bond prices, commodities, and equities during the course of a typical business cycle. Referring back to Figure 2.2, we can see that the bond market is the first financial market to begin a bull phase. This usually occurs after the growth rate in the economy has slowed down considerably from its peak rate, and quite often is delayed until the initial stages of the recession. Generally speaking, the sharper the economic contraction, the greater the potential for a rise in bond prices will be, i.e., a fall in interest rates. Alternatively, the stronger the period of expansion, the smaller the amount of economic and financial slack, and the greater the potential for a decline in bond prices and a rise in interest rates. Following the bear market low in bond prices, economic activity begins to contract more sharply. At this point, participants in the equity market are able to look through the trend of deterioration in corporate profits, which are now declining sharply because of the recession, and to begin accumulating stocks. Generally speaking, the longer the lead between the low in bonds and that of stocks, the greater the potential for the stock market to rally. This is because the lag implies a particularly deep recession in which extreme corporate belt tightening is able to drop break-even levels to a very low level. During the recovery, increases in revenue are therefore able to quickly move to the bottom line. After the recovery has been underway for some time, capacity starts to tighten, resource-based companies feel some pricing power return, and commodity prices bottom. Occasionally, after a commodity boom of unusual magnitude, industrial commodity prices bottom out during the recession as a result of severe margin liquidation due to excessive speculation during the previous boom. However, this low is often subsequently tested, with a sustainable rally only beginning after the recovery has been underway for a few months. At this point, all three financial markets are in a rising trend. Gradually, the economic and financial slack that developed as a result of the recession is substantially absorbed, putting upward pressure on the price of credit, i.e., interest rates. Since rising interest rates mean falling bond prices, the bond market peaks out and begins its bear phase. Because some excess plant and labor capacity still exists, rising business activity results in improved productivity and a continued positive outlook. The stock market discounts trends in corporate profits, so it remains in an uptrend until investors sense that the economy is becoming overheated and the potential for an improvement in profits is very low. At this point, there is less reason to hold equities, and they, in turn, enter into a bear phase. Later on, the rise in interest rates takes its toll on the economy, and commodity prices begin to slip. Once this juncture has been reached, all three financial markets begin to fall. They will continue to decline until the credit markets bottom. This final stage, which develops around the same time as the beginning of the recession, is usually associated with a free fall in prices in at least one of the financial markets. If a panic is to develop, this is one of the most likely points for it to take place. The 6 stages. Since there are 3 financial markets and each has 2 turning points, it follows that there are conceptually 6 turning points in a typical cycle. I call these the 6 stages, and they can be used as reference points for determining the current phase of the cycle. The 6 stages are indicated in Figure 2.4. When identifying a stage, it is important to look at the long-term technical position of all 3 markets so they can act as a cross-check on each other. The stages are also useful in that specific industry groups outperform the market at particular times and vice versa. For example, defensive and liquidity-driven early cycle leaders tend to do well in stages 1 and 2. On the other hand, Earnings-driven or late-cycle leaders perform well in stages 4 and 5 when commodity prices are rallying. These aspects are covered more fully in Chapter 22 on sector rotation. Longer cycles. Some expansions encompass much longer periods, and they usually include at least one slowdown in the growth rate, followed by a second round of economic expansion. This has the effect of splitting the overall expansion into 2 or 3 parts, each of which results in a complete cycle in the financial markets. I call this a double cycle. An example of this phenomenon is illustrated in Figure 2.5. A double cycle developed in the 1980s and another in the 1990s. In the mid-1980s, for example, commodity and industrial parts of the country were very badly affected as a result of the unwinding of the commodity boom that ended in 1980. But the East and West coasts continued their expansions unabated. The strong areas more than offset the weaker ones, and so the country as a whole avoided a recession. The role of technical analysis. Technical analysis comes into play by helping to determine when the various markets have turned in a primary way. This is achieved by applying the various techniques outlined in subsequent chapters, moving average crossovers, changes in the direction of long-term momentum, and so forth. Each market can then be used as a cross-check against the other two. For example, if the weight of the technical evidence suggests that bonds have bottomed, but that commodity prices remain in a bear market, then the next thing to do would be to look for technical signs pointing to a stock market bottom, and so forth. This analysis has also formed the basis of the Dow Jones Pring U.S. Business Cycle Index, symbol DJ Pring, as shown in Chart 2.1. The index uses models to identify the 6 stages, and then allocates assets and equity sectors based on their historical performance in each stage since the mid-1950s. It is far from perfect, but does show consistent long-term results. This methodology is also used in the Pring-Turner Business Cycle ETF, symbol DBIZ. The exchange-traded fund, ET, does not seek to replicate the index, but rather to beat it on a risk-adjusted basis. Market experience, 1966-2001. Chart 2.1 shows how peaks and troughs developed for the various markets between 1966 and 1977. Please note that inversely plotted short-term interest rates have been substituted for bond prices. There is a much closer link between equity prices and short-term rates than with longer-term ones. That is because corporations do more of their borrowing in the money markets than in the bond markets. Short-term rates are also more volatile than those at the end of the yield spectrum. The peaks and troughs turned out very much as expected. While the chronological sequence was more or less perfect, the leads and lags in each cycle varied considerably because of the different characteristics in each cycle. In 1966, for instance, bonds and stocks bottomed more or less simultaneously, whereas the lag for the commodity market bottom was well over a year. Chart 2.2 shows the same markets, but this time we are looking at the 1980s. The 2 small upward-pointing arrows in 1982 and 1990 reflect recessions. Such environments represent good buying opportunities for bonds, but terrible ones for owning commodities. The series of 3 bottoms that developed between 1984 and 1986 reflect the mid-1980s growth recession. Generally speaking, the chronological sequence works satisfactorily until we get to the late 1980s, where the 1989 bottom in rates is juxtaposed with the stock market peak. Unfortunately, these out-of-sequence events are a fact of life. In my experience studying the 200 years of out-of-sequence relationships, I find they represent the exception rather than the rule. Chart 2.3 shows the closing years of the 20th century. This is the most difficult period I have encountered because of the record performance by the stock market and the strong deflationary forces associated with the technological revolution. This had the effect of reducing the normal cyclical fluctuation in the equity market. In the 4th edition of this book, I said, since the stock market boom was unprecedented, it is unlikely that the normal chronological sequences have been more than temporarily interrupted. Chart 2.4 proves that conclusion to be mostly correct, except for the late 2001 low in commodities that preceded equities. One could still argue, though, that the equity market lagged because it was still in the process of unwinding the tech bubble. Remember, it continued to decline even after the 2001 recession ended. Note the double cycle that developed between 2010 and 2012 in Chart 2.5. Summary. 1. A typical business cycle embraces three individual cycles for interest rates, equities, and commodities. All are influenced by the same economic and financial forces, but each responds differently. 2. These markets undergo a chronological sequence that repeats in most cycles. 3. Some cycles experience a slowdown in the growth rate and not an actual recession. Even so, the chronological sequence between markets still appears to operate. 4. The leads and lags vary from cycle to cycle and have little forecasting value. 5. The chronological sequence of peaks and troughs in the various financial markets can be used as a framework for identifying the position of a specific market within its bull or bear cycle. Chapter 3. Dow Theory. Introduction. The Dow Theory is the oldest and by far the most publicized method of identifying major trends in the stock market. An extensive account will not be necessary here, as there are many excellent books on the subject. A brief explanation, however, is in order because the basic principles of the Dow theory are used in other branches of technical analysis. The goal of the theory is to determine changes in the primary, or major, movement of the market. Once a trend has been established, it is assumed to exist until a reversal is proved. Dow theory is concerned with the direction of a trend and has no forecasting value as to the trend's ultimate duration or size. It should be recognized that the theory does not always keep pace with events. It occasionally leaves the investor in doubt, and it is by no means infallible, since losses, as with any other technical approach, are occasionally incurred. These points emphasize that while mechanical devices can be useful for forecasting the stock market, there is no substitute for obtaining additional supportive analysis on which to base sound, balanced judgment. Remember, there are no certainties in technical analysis, because we are always dealing in probabilities. The Dow theory evolved from the work of Charles H. Dow, which was published in a series of Wall Street Journal editorials between 1900 and 1902. Dow used the behavior of the stock market as a barometer of business conditions rather than as a basis for forecasting stock prices themselves. His successor, William Peter Hamilton, further developed Dow's principles and organized them into something approaching the theory as we know it today. These principles were outlined rather loosely in Hamilton's book, The Stock Market Barometer, published in 1922. It was not until Robert Ree published Dow Theory in 1932 that a more complete and formalized account of the principles finally became available. The theory assumes that the majority of stocks follow the underlying trend of the market most of the time. In order to measure the market, Dow constructed two indexes, which are now called the Dow Jones Industrial Average, which was originally a combination of 12, but now includes 30 blue-chip stocks, and the Dow Jones Rail Average, comprising 12 railroad stocks. Since the rail average was intended as a proxy for transportation stocks, the evolution of aviation and other forms of transportation has necessitated modifying the old rail average in order to incorporate additions to this industry. Consequently, the name of this index has been changed to Transportation Average. Interpreting the theory. In order to interpret the theory correctly, it is necessary to have a record of the daily closing two prices of the two averages and the total of daily transactions on the New York Stock Exchange, NYSE. The 6 basic tenets of the theory are discussed in the following sections. 1. The averages discount everything. Changes in the daily closing prices reflect the aggregate judgment and emotions of all stock market participants, both current and potential. It is, therefore, assumed that this process discounts everything known and predictable that can affect the demand/supply relationship of stocks. Although acts of God are obviously unpredictable, their occurrence is quickly appraised and their implications are discounted. 2. The market has three movements. There are simultaneously three movements in the stock market. Primary movement, the most important, is the primary or major trend, more generally known as a bull rising or bear falling market. Such movements last from less than 1 year to several years. A primary bear market is a long decline interrupted by important rallies. It begins as the hopes on which the stocks were first purchased are abandoned. The second phase evolves as the levels of business activity and profits decline. In the third stage, the bear market reaches a climax when stocks are liquidated, regardless of their underlying value, because of the depressed state of the news or because of forced liquidation caused, for example, by margin calls. A primary bull market is a broad upward movement, normally averaging at least 18 months, which is interrupted by secondary reactions. The bull market begins when the averages have discounted the worst possible news and confidence about the future begins to revive. The second stage of the bull market is the response of equities to known improvements in business conditions, while the third and final phase evolves from overconfidence and speculation, when stocks are advanced on projections that usually prove to be unfounded. Secondary reactions. A secondary or intermediate reaction is defined as an important decline in a bull market or advance in a bear market, usually lasting from 3 weeks to as many months, during which interval the movement generally retraces from 33 to 66% of the primary price change since the termination of the last preceding secondary reaction. 3. This relationship is shown in Figure 3.1. Occasionally, a secondary reaction can retrace the whole of the previous primary movement, but normally, the move falls in the 1/2 to 2/3 area, often at the 50% mark. As discussed in greater detail later, the correct differentiation between the first leg of a new primary trend and a secondary movement within the existing trend provides Dow theorists with their most difficult problem. Minor movements. The minor movement lasts from a week or two up to as long as 6 weeks. It is important only in that it forms part of the primary or secondary moves. It has no forecasting value for longer-term investors. This is especially important since short-term movements can be manipulated to some extent, unlike the secondary or primary trends. 3. Lines indicate movement. Redefined a line as a price movement 2 to 3 weeks or longer, during which period the price variation of both averages moves within a range of approximately 5% of their mean average. I see no reason why the 5% rule cannot be exceeded. After all, it really represents a digestion of gains or losses or a pause in the trend. Such a movement indicates either accumulation. 4. An advance above the limits of the line indicates accumulation and predicts higher prices, and vice versa. When a line occurs in the middle of a primary advance, it is really forming a horizontal secondary movement and should be treated as such. My own view is that the formation of a legitimate line should probably take longer than 2 to 3 weeks. After all, a line is really a substitute for an intermediate price trend, and 2 to 3 weeks is the time for a short-term or minor price movement. 4. Price/volume relationships provide background. The normal relationship is for volume to expand on rallies and contract on declines. If it becomes dull on a price advance and expands on a decline, this is a warning that the prevailing trend may soon be reversed. This principle should be used as background information only, since the conclusive evidence of trend reversals can be given only by the price of the respective averages. 5. Price action determines the trend. Bullish indications are given when successive rallies penetrate peaks while the trough of an intervening decline is above the preceding trough. Conversely, bearish indications come from a series of declining peaks and troughs. Figure 3.2 shows a theoretical bull trend interrupted by a secondary reaction. In example A, the index makes a series of 3 peaks and troughs, each higher than its respective predecessor. The index rallies following the third decline, but is unable to surpass its third peak. The next decline takes the average below its low point, confirming a bear market as it does so, at point X. In example B, following the third peak in the bull market, a bear market is indicated as the average falls below the previous secondary trough. In this instance, The preceding secondary was part of a bull market, not the first trough in a bear market, as shown in example A. Many Dow theorists do not consider penetration at point X in example B to be a sufficient indication of a bear market. They prefer to take a more conservative position by waiting for a rally and subsequent penetration of that previous trough, marked as point Y in example B. In such cases, it is wise to approach the interpretation with additional caution. If a bearish indication is given from the volume patterns and a clearly identifiable speculative stage for the bull market has already materialized, it is probably safe to assume that the bearish indication is valid. In the absence of such characteristics, it is wiser to give the bull market the benefit of the doubt and adopt a more conservative position. Remember, technical analysis is the art of identifying trend reversals based on the weight of the evidence. Dow theory is one piece of evidence, so if 4 or 5 other indicators are pointing to a trend reversal, it is usually a good idea to treat the half signal at point X as an indication that the trend has reversed. Examples C and D represent similar instances at the bottom of a bear market. The examples in Figure 3.3 show how the primary reversal would appear if the average had formed a line at its peak or trough. The importance of being able to distinguish between a valid secondary correction and the first leg of a new primary trend is now evident. This is perhaps the most difficult part of the theory to interpret and unquestionably the most critical. It is essential to establish that the secondary reaction has retraced at least 1/3 of the ground of the preceding primary movement, as measured from the termination of the preceding secondary. The secondary should also extend for at least 3 to 4 weeks. Vital clues can also be obtained from volume characteristics and from an assessment of the maturity of the prevailing primary trend. The odds of a major reversal are much greater if the market has undergone its third phase, characterized by speculation and false hopes during a primary upswing, or a bout of persistent liquidation and widespread pessimism during a major decline. A change in the primary trend can occur without a clearly identifiable third phase, but generally, such reversals prove to be relatively short-lived. On the other hand, the largest primary swings usually develop when the characteristics of a third phase are especially marked during the preceding primary movement. Hence, the excessive bouts of speculation in 1919, 1929, 1968, and 2000 in the Nasdaq were followed by particularly sharp setbacks. Intermediate-term movements are discussed more extensively in Chapter 4. Quite often, a reversal in an 18-month rate of change rock from a reading in excess of 200% is reflective of such an exhaustion of buying power. 6. The averages must confirm. One of the most important principles of Dow theory is that the movement of the industrial average and the transportation average should always be considered together, i.e., the two averages must confirm each other. The need for confirming action by both averages would seem fundamentally logical, for if the market is truly a barometer of future business conditions, investors should be bidding up the prices, both of companies that produce goods and of companies that transport them, in an expanding economy. It is not possible to have a healthy economy in which goods are being manufactured but not sold, i.e., shipped to market. This principle of confirmation is shown in Figure 3.4. In example A, the industrial average is the first to signal a bear trend point A, but the actual bear market is not indicated until the transportation average confirms at point B. Example B shows the beginning of a new bull market. Following a sharp decline, the industrials make a new low. A rally then develops, but the next reaction holds above the previous low. When prices push above the preceding rally, a bull signal is given by the industrials at point A. In the meantime, the transportation average makes a series of 2 succeeding lows. The question that arises is which average is correctly representing the prevailing trend. Since it is always assumed that trend is in existence until a reversal is proved, the conclusion should be drawn at this point that the transportation average is indicating the correct outcome. It is only when this average exceeds the peak of the preceding secondary at point B that a new bull market is confirmed by both averages, resulting in a Dow theory buy signal. The movement of one average unsupported by the other can often lead to a false and misleading conclusion, which is well illustrated in Figure 3.5, which shows the 1930 price action in wave form. The 1929-1932 bear market began in September 1929 and was confirmed by both averages in late October. In June 1930, each made a new low and then rallied and reacted in August. Following this correction, the industrials surpassed their previous peak. Many observers believed that this signaled the end of a particularly sharp bear market and that it was only a matter of time before the rails would follow suit. As it turned out, the action of the industrials was totally misleading. The bear market still had another 2 years to run. The theory in action, 1998-2013. Chart 3.1 compares the industrials to the transports between 1997 and 2013. The chart opens during the tail end of the 1982-2000 secular bull market. The transports gave a non-confirmed sell signal in 1998 following a zigzag down. The industrials also broke to a new low, but since the previous July's high was above the April one, our strict interpretation said a non-confirmed bear market. Since the transports remained in a bearish mode until 2004, all that was required for a sell signal was industrial confirmation, and that came in October 2000 as this average broke down from a line formation. Fortunes were reversed in early 2003 as the industrials went bullish, but the transports were unable to follow suit since they made a new low in early 2003. Unlike their industrial counterparts, who were able to give an unconfirmed bull signal at D. Consequently, it was not until the transports broke out of a line formation at E that a new bull market was signaled. The next event developed at F when the industrials broke below their previous intermediate low. The transportations eventually confirmed in November 2008 at G. The subsequent bull market was signaled by the transports with a line breakout in early 2009, H, and subsequently confirmed by the industrials in June at I. This buy signal is arguably controversial since the intermediate correction only lasted for 4 weeks, acceptable but somewhat on the low side. Also, the correction retraced just 30% of the previous advance, 33.3 to 66.23 being the normal accepted limits. Additional considerations. Dow theory does not specify a time period beyond which a confirmation of one average by the other becomes invalid. Generally, the closer the confirmation, the stronger the following move is likely to be. I have noticed that this principle can be extended to other techniques used in technical analysis, especially in conjunction with momentum/price considerations. See Chapter 13. For example, confirmation of the 1929-1932 bear market was given by the rail average just 1 day after the industrial average. The sharp 1962 break was confirmed on the same day. One of the major criticisms of Dow theory is that many of its signals have proved to be late, often 20 to 25% after a peak or trough in the averages has occurred. One rule of thumb that has enabled Dow theorists to anticipate probable reversals at an earlier date is to observe the dividend yield on the industrials. When the yield on the industrial average has fallen to 3% or below, it has historically been a reliable indicator at marker tops. This was certainly true prior to the mid-1990s and has been more questionable since then. Similarly, a yield of 6% has been a reliable indicator at market bottoms. Dow theorists would not necessarily use these levels as actual buying or selling points, but would probably consider altering the percentage of their equity exposure if a significant non-confirmation developed between the industrial average and the transportation average when the yield on the Dow reached these extremes. This strategy would help to improve the investment return of the Dow theory, but would not always result in a superior performance. At the 1976 peak, for example, the yield on the Dow never reached the magic 3% level, and prices fell 20% before a mechanical signal was confirmed by both averages. In addition, the 3% top would have missed the mark by about 5 years in the late 1990s. Over the years, many criticisms have been leveled at the theory on the basis that from time to time, as in periods of war, the rails have been overregulated, or that the new transportation average no longer reflects investors' expectations about the future movement of goods. The theory has stood the test of time, however, as Table 3.1 indicates. Indeed, criticism is perfectly healthy, For if the theory gained widespread acceptance and its signals were purely mechanistic instead of requiring experienced judgment, they would be instantly discounted, which would render Dow theory useless for profitable investment. In any event, it is important to note that it is far from perfect, and in any case, Dow theory should be regarded as one indicator that should be used with others in the technical arsenal. Summary. 1. Dow theory is concerned with determining the direction of the primary trend of the market, not its duration or size. Once confirmed by both averages, the new trend is assumed to be in existence until an offsetting confirmation by both averages takes place. 2. Major bull and bear markets each have 3 distinct phases. Both the identification of these phases and the appearance of any divergence in the normal volume/price relationship offer useful indications that a reversal in the major trend is about to take place. Such supplementary evidence is particularly useful when the action of the price averages themselves is inconclusive. Chapter 4. Typical parameters for intermediate trends. Some basic observations. The 2 previous chapters discuss the main or primary trend, i.e., the price movement that corresponds to changes in economic activity over the course of a typical 3 to 4 year business cycle. Though it is clearly important to have an idea of the direction and maturity of the primary trend, it is also helpful to have some understanding of the typical character and duration of the intermediate trend for the purpose of improving success rates in trading, and also to help assess when the primary movement may have run its course. This chapter focuses on intermediate trends in the U.S. stock market, but the principles outlined here apply to any freely traded entity. Successful analysis of intermediate trends for any market or stock offers the following advantages. 1. Changes in intermediate trends aid in identification of turning points in the primary trend. 2. Intermediate term trading involves fewer transactions than trading of minor price movements, and therefore results in lower commission and execution costs. 3. Intermediate trend reversal points occur several times a year and can, if properly interpreted, allow a relatively high and quick return on capital. Intermediate cycles defined. A primary trend typically consists of 5 intermediate trends, 3 of which form part of the prevailing trend, while the remaining 2 run counter to that trend. In a bull market, the intermediate countertrends are represented by price declines. In a bear market, they form rallies that separate the 3 intermediate down waves, as shown in Figure 4.1. It is apparent from this discussion that there are essentially 2 types of intermediate price movements. The first, which goes in the direction of the primary trend, may be called a primary intermediate price movement. The second is an important price movement that lasts from 3 weeks to 3 months, occasionally longer. It normally retraces between 1/3 and 2/3 of the preceding primary intermediate trend. This price movement, which runs counter to the main trend, is called a secondary movement or reaction. Since a primary intermediate price movement operates in the same direction as the primary or main market trend, it almost always lasts longer than its secondary counterpart. Its price magnitude is normally much greater as well. These countertrends or reactions against the main trend are notoriously difficult to forecast in terms of character, magnitude, and duration. Therefore, they should generally be avoided from a trading point of view, as they will almost invariably be subject to confusing whipsaws. By their very nature, they tend to fool the majority and are usually extremely treacherous. It is possible to design successful mechanized systems based on intermediate price movements, but poor or losing signals usually come from secondary market movements that occur against the main trend. Intermediate term trends that move in the same direction as the primary trend are generally easier to profit from. Those who do not have the patience to invest for the longer term will find that successful analysis of intermediate movements offers superior results, especially as the day-to-day or minor swings are, to a large degree, random in nature and therefore even more difficult to capitalize on. This tendency has been most pronounced in recent years, when increasingly sharp price movements have resulted from emotional knee-jerk reactions to the release of unexpected economic data. A secondary reaction does not have to be a decline in a bull market or a bear market rally. It can also take the form of a sideways movement or consolidation, under the same idea as Charles Dow's line formation. See the discussion in Chapter 3. Intermediate movements can go either with or against the main trend, which means that there is an intermediate cycle similar to a primary one. An intermediate cycle consists of a primary intermediate price movement and a secondary reaction. It extends from the low of one intermediate trend to the low of the other, as shown in Figure 4.2. In a bull market, the up phase of the cycle should be longer in time and greater in magnitude. The low on the secondary reaction should be higher than its predecessor. In a bear market, the reverse conditions hold true, i.e., declines are longer and greater, while rallies are shorter and sharper, but of less magnitude. Accordingly, technicians are alerted first to the possibility of a reversal in the primary trend when a third intermediate cycle is nearing completion. It is also important to note whether the overall technical structure looks weak, strong in a bear market, as the previous intermediate low-high is approached, and finally, to note whether that level is decisively broken on the downside-upside. This does not mean that primary movements can never encompass more or fewer than 3 primary intermediate price movements, for often they do. Expect 3 as a normal event, but do not be caught off guard if there are fewer or more. Causes of secondary reactions. Since the primary trend of stock prices is determined by the attitudes of investors to the future flow of profits, which are, in turn, determined to a large degree by the course of the business cycle, it would seem illogical at first to expect longer-term movements to be interrupted by what often prove to be very uncomfortable reactions, or in the case of a bear market, very deceptive rallies. History shows that secondary reactions occur because of technical distortions, which arise in the market as a result of over-optimism or over-pessimism, and also because new factors emerge that suggest business conditions are not going to be as extreme as was originally anticipated, or even that they are going to materialize in the opposite direction. For example, after the first intermediate-term rally in a bull market for equities, a reaction may develop because investors, who had discounted a strong recovery, now see some chinks appearing that might even forecast an actual decline in business conditions. Such fears eventually prove ungrounded, but are sufficient to cause a countercyclical intermediate reaction. Another possibility might be a fear of rising interest rates, which could choke off the recovery. Since prices had discounted a strong recovery, this change in perception causes investors to pull back and prices to fall accordingly. At the same time, many investors get carried away during the rally phase and leverage themselves up. As prices begin to fall, this causes their equity to shrink and forces them to liquidate, which adds further fuel to the price decline. A bear market rally for stocks generally takes place because of an improved outlook for business conditions over what was anticipated. A bear market rally for bonds develops under the opposite set of conditions. Corrections in commodity and currency markets all have their roots in a changed, but incorrect, perception of the underlying primary economic trend. The catalyst for the rally is the rush by traders and investors to cover their short positions. For a definition and explanation of short selling, see the glossary. It should be added that the apparent motivating force for the correction need not necessarily be directly linked to the outlook for business or interest rates. Any of these influences could be the excuse for a countercyclical intermediate price movement. It could be linked to the anticipated resolution or worsening of a political or military problem, for example. Essentially, the change in anticipated conditions, combined with the unwinding of the technical distortions of the previous primary intermediate trend and its associated sharp price movement, are sufficient to confuse the majority. Only when business conditions are correctly expected to change from recovery to recession, or vice versa, is the primary trend of equities likely to reverse. Note the emphasis on the word likely. Although equity prices fluctuate around perceived future economic conditions, there have been exceptions. For example, the economy moved out of recession at the end of 2001, yet stocks continued to decline into October 2002. In that case, it would appear that the unwinding of the tech bubble was a stronger influence than was improving economic activity. That sort of decoupling, though, is far more the exception than the rule. In his excellent book Profits in the Stock Market, Lambert Gann Publishing, 1935, H. M. Gartley pointed out that in the 40 years ending in 1935, 2/3 of all bull market corrections in the U.S. stock market developed in two waves of liquidation separated by a minor rally that retraced between 1/3 and 2/3 of the first decline. Observation of such corrections since 1935 also bears out the finding that most intermediate corrections consist of two, rather than one or three, phases of liquidation. Unfortunately, intermediate corrections within a bear market cannot be so easily categorized since some are one-move affairs or consist of a rally out of a small base, while still others unfold as a very volatile sideways movement. Even though Gartley's observations were concerned with the equities, this form of correction applies to all financial markets. Relationship between primary intermediate moves and subsequent reactions. In Profits in the Stock Market, Gartley published a series of diagrams using the classification of intermediate trends established by Robert Ree. Gartley's conclusion was that the smaller in magnitude the primary intermediate term movement was, the larger the retracement tended to be, and vice versa. He noted that this was just as valid for bull market reactions as for bear market rallies. Observations of the period since 1933 for virtually all markets appear to support this hypothesis. For example, the rally off the 1962 stock market low was only 18%, compared to the mean average of 30% between 1933 and 1982. This represented part of a double bottom formation, and therefore, the first primary intermediate rally. This relatively small advance was followed by a somewhat larger 71% retracement. However, the ensuing rally from late 1962 until mid-1963 was 32% and was followed by a small 25% retracement of the gain. Interested readers may wish to be satisfied that what goes up does not necessarily come down, and vice versa. The 1976-1980 gold bull market was very powerful, but the intermediate corrections were quite brief. On the other hand, the rallies between 1982 and 1990 were far less strong, but were followed by corrections of much greater magnitude proportionally. Using intermediate cycles to identify primary reversals. Number of intermediate cycles. Primary movement may normally be expected to encompass 2.5 intermediate cycles. See Figure 4.3. Unfortunately, not all primary movements correspond to the norm. An occasional primary movement may consist of 1, 2, 3, or even 4 intermediate cycles. Furthermore, these intermediate cycles may be of very unequal length or magnitude, making their classification and identification possible only after the event. Even so, intermediate cycle analysis can still be used as a basis for identifying the maturity of the primary trend in most cases. Whenever prices are well advanced in a primary intermediate trend, following the complication of 2 intermediate cycles, technicians should be alerted to the fact that a reversal of the primary trend itself may be about to take place. Again, if only one intermediate cycle has been completed, the chances of prices reaching higher levels, lower levels in a bear market are quite high. Characteristics of the final intermediate cycle in a primary trend. In addition to actually counting the number of intermediate cycles, it is possible to compare the characteristics of a particular cycle with those of a typical pivotal or reversal cycle of a primary trend. These characteristics are discussed in the following sections. Reversal from bull to bear market. Since volume leads price, the failure of volume to increase above the levels of the previous intermediate cycle-up phase is a bearish sign. Alternatively, if over a period of 3 to 4 weeks, volume expands on the intermediate rally close to the previous peak in volume, but fails to move prices significantly, it represents churning and should also be treated bearishly. Coincidence of either of these characteristics with a downward crossover of a 40-week moving average, see Chapter 11, or a divergence in an intermediate-term momentum index, see Chapter 13, would be an additional reason for caution. There are essentially 2 broad characteristics that suggest that the downward phase of an intermediate cycle could be the first down leg of a bear market. The first is a substantial increase in volume during the price decline. The second is a cancellation or retracement of 80% or more of the up phase of that same intermediate cycle. The greater the retracement, the greater the probability that the basic trend has reversed, especially because a retracement in excess of L00% means that any series of rising troughs has been broken, thereby placing the probabilities in favor of a change in the primary trend. Other signs would include the observation of a mega oversold or an extreme swing. See Chapter 13 on momentum for a full explanation of these terms. Reversal from bear to bull market. The first intermediate up phase of a bull market is usually accompanied by a substantial expansion in volume that is significantly greater than those of previous intermediate up phases. In other words, the first up leg in a bull market attracts noticeably more volume than any of the intermediate rallies in the previous bear market. Another sign of a basic reversal occurs when prices retrace at least 80% of the previous decline. Again, the greater the proportion of retracement, the greater the odds of a reversal in the basic trend. If the retracement is greater than 100%, the odds clearly indicate that a reversal in the downward trend has taken place because the series of declining peaks will have broken down. Since volume normally expands substantially as the intermediate down phase during a bear market reaches a low, a shrinkage in volume during an intermediate decline could well be a warning that the bear market has run its course. This is especially true if the price does not reach a new low during this intermediate decline, since the series of declining intermediate cyclical lows, which is a characteristic of a bear market, may no longer be intact. An example of this is shown in Chart 8.12, where the overall peak in volume was seen in the June 1962 decline rather than the August-October sell-off. A final sign might include a mega overbought condition or an extreme swing. Again, please refer to Chapter 13 for an explanation of these concepts. Intermediate trends in the U.S. Stock market, 1897-1982. Amplitude and duration of primary intermediate up moves. Between 1897 and 1933, Robert Ree, the author of Dow Theory, classified 53 intermediate trend advances within a primary bull market, which ranged in magnitude from 7 to 117%, as shown in Table 4.1. I have classified 35 intermediate term moves between 1933 and 1982, and the median averaged 22% from low to high. The results are shown in Table 4.2. The median average primary intermediate advance since 1897 appears to be around 20 to 22%. The median primary intermediate up move in the 1933-1982 period does not differ from that of the earlier period classified by Ree. However, the median duration appears to have increased considerably, from 13 weeks in the 1897-1933 period to 24 weeks in the 1933-1982 period. Amplitude and duration of primary intermediate down moves using Ree's classification. 39 cases of a primary intermediate decline developed between 1900 and 1932, as summarized in Table 4.3. My research shows that between 1932 and 1982, there were 35 primary intermediate declines, with a median of 16%. The decline was measured as a percentage from the high. The results are summarized in Table 4.4. The results in the 1932-1982 period did not differ appreciably from those in the 1897-1933 period. Ree's median average swing was 18%, as compared to the more recent 16%, whereas the median duration in the earlier period was 13 weeks, as compared to 14 weeks in the 1932-1982 period. Amplitude, duration, and retracement of bull market intermediate corrections. Bull market secondary reactions. Between 1898 and 1933, Ree classified 43 cases of bull market secondaries. In terms of retracement of the previous primary intermediate up move, they ranged from 12.4 to 180%, with a median of 56%. This compared with a range in the 1933-1982 period from 25 to 148%, with a median of 51%. The duration of the median in the earlier period was 5 weeks, as compared to 8 weeks between 1933 and 1982. The median percentage loss from the previous primary intermediate peak was 12%. The mean average was 13% between 1933 and 1982. Bear market rallies. Ree estimated that the median bear market rally retraced 52% of the previous decline, which is comparable to my own median estimate of 61% in the 1932-1982 period. The two ranges were 30 and 116% and 26 and 99%, respectively. Median durations were 6 weeks in 1898-1933 and 7 weeks in 1932-1982. Rallies off the low averaged 12 and 10% for mean and median, respectively, for the 1933-1982 period. Since 1982, charts 4.1 and 4.2 show the S&P composite between the end of 1982 and the opening of the 21st century. The thick vertical lines approximate intermediate rally peaks and the thin ones intermediate troughs. The lower panel contains an intermediate oscillator, the intermediate no-sure thing KSD. See Chapter 15 for an explanation, which roughly reflects the turning points. This period encompassed the secular bull market that began in 1982 and ended at the turn of the century, as well as the subsequent secular bear. The classification of intermediate trends was particularly difficult compared to previous periods. I tried as much as possible to make the intermediate trends fit the swings in the oscillator. Because oscillators have a tendency to lead in bull markets, the actual peaks in the intermediate rallies usually lag those in the KSD. The two charts show that the classification of these trends is far from a precise task and confirms earlier research between 1897 and 1982 that the range of intermediate trends varies tremendously. In the period covered by Chart 4.1, for instance, the first intermediate rally in the bull market lasted well over a year, from August 1982 to October 1983. Even if I had taken the July 1983 top as a reference point, the rally would still have lasted for almost a year. Moreover, the whole year of 1995 was consumed by one complete intermediate advance. Chart 4.3 fills in the balance of the picture until 2012. Note the particularly lengthy 2008 and 2009 trends, first on the downside and later on the upside. Summary. 1. A typical primary trend can be divided into 2.5 primary intermediate cycles, each consisting of an up move and a down move. In a bull market, each successive up wave should reach a new cyclical high, and in a bear market, each successive down wave of the intermediate cycle should reach a new low. Breaking the pattern of rising lows and falling peaks is an important, but not unequivocal, warning of a reversal in the primary trend. For more conclusive proof, technicians should derive a similar conclusion from a consensus of indicators. 2. A secondary movement or reaction is that part of an intermediate cycle that runs counter to the main trend, a downward reaction in a bull market or a rally in a bear market. Secondary intermediate movements typically last from 3 weeks to 3 months and retrace between 1/3 and 2/3 of the previous primary intermediate price movement. Secondary price movements may also take the form of a line or horizontal trading pattern. 3. The character of intermediate cycles can be used to help identify primary trend reversals. 4. As an approximate rule, the stronger an intermediate rally in a bull market, the less the retracement is likely to be. Chapter 5. How to identify support and resistance zones. Support and resistance are two basic building blocks of the technical arsenal. They form a key role in price pattern analysis, which we will address later. A lot of people use the term support when they really mean resistance, and use resistance when they really mean support. It's no wonder that there is a lot of confusion. Basically, these are points on a chart where the probabilities favor at least a temporary halt in the prevailing trend. Support and resistance. In their classic book, Technical Analysis of Stock Trends, Edwards and Maggi define support as buying actual or potential sufficient in volume to halt a downtrend in prices for an appreciable period, and resistance as selling actual or potential sufficient in volume to satisfy all bids and hence stop prices from going higher for a time. A support zone represents a concentration of demand, whereas resistance represents a concentration of supply. The word concentration is emphasized because supply and demand are always in balance. However, it is the relative enthusiasm of buyers as compared to sellers, or vice versa, that is important because that is what determines trends. If buyers are more enthusiastic than sellers, they will continually increase their bids until their purchasing demands have been satisfied. On the other hand, if sellers are the more anxious, then they will be willing to liquidate at lower prices and the general price level will fall. If in doubt, think of support as a temporary floor for prices and resistance as a ceiling. At the beginning of Figure 5.1, the price is declining. It finds a bottom at A and then moves up. The next time it falls to A, it again rallies, so it may now be said to be a support area. This establishes our first principle of support/resistance analysis, major technical principle. A previous high or low is a potential resistance/support level. The third time the price slips to A, it goes through, or as we say, it violates support. One of the first principles of identifying a potential support level, then, is to look for previous lows. In the case of potential resistance, this would be in the area of a previous high. Figure 5.2 shows a more extended example. This time, the price found temporary support at B. C also proves to be a support point, but note that the rallies are reversed at support level B. Thus, the second principle is major technical principle. Support reverses its role to resistance on the way up. Just think of it this way: a floor in a building acts as a support zone, but when you fall through it, the floor now becomes resistance, called a ceiling. The reason why support and resistance reverse their roles can be appreciated with an explanation of some elementary psychology. No one likes to take a loss, and while some people overcome this feeling by cutting their losses at an early stage, others hold on until the price comes back to where the security in question was originally bought. At that point, they are able to break even and sell, thereby creating a quantity of supply sufficient to temporarily halt the advance. Finally, in Figure 5.3, we see the price rally through resistance at B and A, the former support level. The ensuing decline then finds support at A again. Thus, our third principle is major technical principle. Resistance reverses its role to support on the way down. Rules for determining potential support/resistance points. Previous highs and lows. We have already established that previous highs and lows are potential support or resistance levels. Highs are important because many market participants may have bought close to or at the actual high for a move. When prices decline, the normal human response is not to take a loss, but to hold on. That way, the pain of actually realizing a loss can be avoided. As a result, when the price returns to the old high, those who bought at that level have great motivation to sell in order to break even. Consequently, they liquidate. Also, those who bought at lower prices have a tendency to take profits at the old high, since that is the top of familiar ground. By the same token, any prices above the old high look expensive to potential buyers. Consequently, there is less enthusiasm on their part, so they begin to pull away from the market. When a price rallies and then falls back to the previous low, these bargain basement prices appeal to potential buyers. After all, they missed the opportunity the first time prices retreated to this level, and they are therefore thankful to have another chance. For the same reason, sellers are reluctant to part with their securities as prices approach the previous low, since they saw them bounce before and naturally wonder why the same process should not be repeated. Chart 5.1 shows the sugar price for a period spanning 2002-2003. Note how previous highs and lows offer good support/resistance points for future trading. Unfortunately, there is no way of knowing whether a particular level will turn out to be support or resistance, or even whether it will be a pivotal point at all. That's why these are merely intelligent places for anticipating a temporary reversal. Resort to other indicators such as oscillators is therefore required. At round numbers, support and resistance zones have a habit of forming at round numbers. This is probably because numbers such as 10, 50, or 100 represent easy psychological points upon which traders and investors often base their decisions. In the 1970s, for example, the Dow Jones Industrials had a great deal of difficulty surpassing the 1,000 level. For gold in the 1980s and mid-1990s, the magic number was $400, and so forth. The guide for potential turning points, then, is to look for round numbers. Trend lines and moving averages represent dynamic levels of support and resistance. Chapter 6 points out that a good trend line should reflect the underlying trend. One of the rules for assessing the significance of a line relates to how many times it has been touched or approached. The more, the merrier in this case. If a price falls back to a specific low on several occasions, this makes that particular price level a strong support zone. The same is true of trend lines and moving averages, MA. Every time a price moves back to an uptrend line or a rising MA and bounces, it is reinforced as a dynamic level of support. The same would be true in reverse for a declining trend line or moving average. Therefore, it makes sense to buy as the price falls to an uptrend line or rising MA, and to sell when it rises to a downtrend line or falling MA. A low-risk stop may then be placed just beyond the line or MA in case the support/resistance zone is violated. Chart 5.2 shows a very good example of how a downtrend line acted as resistance for Hewlett-Packard. Note also that the interaction of a reliable MA, such as the 200-day MA featured in this chart, acts as reinforcement of the resistance zone. This works in the same way as if we were building a house and doubled the thickness of the roof. The identical principle holds when a moving average and a trend line are at the same level. They double the strength of the resistance, or support in the case of an uptrend line and MA intersection. Emotional points on a chart represent potential support/resistance levels. This concept will be covered in subsequent chapters when we consider gaps, extreme points of Pinocchio bars, two-bar reversals, key reversals, and so forth. For the moment, suffice it to say that most emotional points are those at which a price, following a persistent trend, experiences a strong extension of that trend. During the course of the bar's formation, it then abruptly reverses direction. It's the abruptness of the reversal that is the key, since it tells us, depending on the direction, that either buyers or sellers are exhausted. When that point in the chart is again revisited, it often forms a barrier to further progress, in other words, a support or resistance level. Gaps represent another example of emotional points. They are formed when buyers or sellers respond so emotionally to news that a blank space, or gap, is left on the chart. In Chart 5.3, probably because of unexpected bad news, the sugar price experiences 3 downside gaps. Later on, when emotions become more stable, the price rallies and tries to close each of the gaps. In the case of the gap on the left, resistance is found at its opening. In the other two examples, resistance forms at the lower part of the gap. Gaps are one of the most reliable technical concepts from the point of view of projecting potential support or resistance areas. We see some good examples in 2011 for the Market Vectors Coal Exchange Traded Fund et. Chart 5.4, where the small rectangles highlight the gaps and the horizontal lines represent the high and low for the gap, with their obvious support implications. Chart 5.5 shows another emotional point for Boeing. This time, it's the bottom of a very wide bar in early 2002. Note that this low developed at around number $50. Normally, this would have been a support level the next time the price fell to $50, but in the fall of 2002, the price went right through it. Even so, $50 did turn out to be a pivotal point the next time Boeing rallied. It goes to show that even if a support/resistance zone is violated once, it can still turn out to be a pivotal point in subsequent price action. Proportionate moves, retracements, and so on, the law of motion, states that for every action, there is a reaction. Price trends established in financial markets are really the measurement of crowd psychology in motion, and are also subject to this law. These swings in sentiment often show up in proportionate price moves. Perhaps the best-known principle of proportion is the 50% rule. For instance, many bear markets, as measured by the Dow Jones Industrial Average (GIA), have cut prices by half. As examples, the 1901-1903, 1907, 1919-1921, and 1937-1938 bear markets recorded declines of 46, 49, 47, and 50%, respectively. The first leg of the 1929-1932 bear market ended in October 1929 at 195, just over half the September high. The halfway mark in an advance sometimes represents the point of balance, often giving a clue to the ultimate extent of the move in question or, alternatively, indicating an important juncture point for the return move. Thus, between 1970 and 1973, the Dow advanced from 628 to 1,067. The halfway point in that rise was 848, or approximately the same level at which the first stage of the 1973-1974 bear market ended. By the same token, rising markets often find resistance after doubling from a low. The first rally from 40 to 81 in the 1932-1937 bull market was a double. In effect, the 50% mark falls in the middle of the 1/3 to 2/3 retracement described in Chapter 2 in the discussion of peak and trough progression. These 1/3 and 2/3 proportions can be widely observed in all securities and also serve as support or resistance zones. Ratio scale charts are helpful in determining such points, since moves of identical proportion can easily be projected up and down. Acircumflex, moreover, these swings occur with sufficient consistency to offer possible reversal points at both peaks and troughs. Remember, technical analysis deals with probabilities, which means that forecasts should not be made using this method in isolation. In addition, when undertaking a projection based on the rules of proportion, it is always a good idea to see whether the price objective corresponds to a previous support or resistance point. If it does, the odds are much higher that this zone will represent a reversal point, or at least a temporary barrier. When a security price is reaching new all-time high ground, another possibility is to try to extend up trend lines. The point at which the line intersects with the projection using the rules of proportion may well represent the time and place of an important reversal. Experimentation will show that each security has a character of its own, with some lending themselves more readily to this approach and others not at all. Chart 5.6 shows an example using 1/3, 2/3, and 50% retracements for the PowerShares Dynamic Insurance ETF. In this instance, the decline from the 100% line to the 0% line, A, is 100% of the move. If we want to establish possible resistance points for subsequent rebounds, then the intelligent places to monitor are these 1/3, 2/3, and 50% retracements. As you can see, the rally ending at B, C, and D represent a 33%, 50%, and 66% or 2/3 retracement, respectively. These pivot levels remain in force once surpassed. You can see this from the decline at E, which was halted at the 33% mark. While we do not know ahead of time when these retracement moves will halt at the 1/3, 50%, or 2/3 pivotal points, we can certainly get some clues by examining some of the other technical indicators as the price approaches these junctures to see if things are, in fact, consistent with a turn. Many technicians use a sequence of numbers discovered by Leonardo Fibonacci, a 13th century Italian mathematician. The sequence has many properties, but a key one is that each new number is the sum of the two previous numbers in the series. Thus, 5 and 8 equals 13, 8 and 13 equals 21, and so on. The significance of this sequence for our purposes is that it offers some guidelines for proportionate moves. For example, each number in the sequence is 61.8% of the next number, 38.2% of the number after that, and so forth. In this respect, charts 5.7 and 5.8 show some possibilities for the silver ETF. The retracement moves are measured in exactly the same way as in the previous chart, except that Fibonacci numbers have been acircumflex substituted. In the case of chart 5.7, the initial rally was halted at the 23.6% level, the next at 50%, and the third move up at a level just shy of 61.8% of the March to September 2008 decline. We can also see that an advance was held at the 50% mark at E and at the 61.8% level either side of F. In chart 5.8, we see how the 38.25 level comes into play a couple of times, and the value of a gap opening as two rallies were turned back at B and later at D. Note this very same level was reinforced as a pivotal point, not only because of its importance as a gap opening, but also as a 38.2% retracement level, as we can see at D. Finally, previous lows as a support-generating principle came into their own at C. Chart 5.9 shows the same principle applied to upside projections. Once again, AB represents 100% of the decline and lines are drawn at upside Fibonacci proportions. In this case, the next higher number divided by the current number is 1.61, then 2.61, and so on. It is self-evident how the 161.8% and 261.8% proportions become key pivotal points in future price action. Once again, these levels are not guaranteed to become important pivotal points, but are intelligent places on the chart to anticipate that possibility. Rules for determining the probable significance of a potential support or resistance zone. At this point, you are probably asking, how do I know how important each support and resistance level is likely to be? Unfortunately, there is no hard and fast answer, but there are some general rules that can act as guidelines. The amount of a security that changed hands in a specific area, the greater the activity, the more significant the zone. This is fairly self-evident, for whenever you have a large number of people buying or selling at a particular price, they have a tendency to remember their own experiences. Buyers, as we have already established, like to break even. Sellers, on the other hand, may have bought lower down and recall that prices previously stalled at the resistance level. Their motivation for profit-taking becomes that much greater. The greater the speed and extent of the previous move, the more significant a support or resistance zone is likely to be. The attempt to climb through the resistance level here can be compared to the efforts of a person who tries to crash through a door. If he attacks the door from, say, 10 or 12 feet away, he can propel himself with lots of momentum, and the door will probably give way. On the other hand, if he begins his attempt from 100 feet away, he will arrive at the door with less velocity and will probably fail in his attempt. In both cases, the door represented the exact same resistance, but it was the resistance relative to the velocity of the person that was important. The same principle can be applied to the market, in that a long, steep climb in price is similar to the 100-foot run, and the resistance level resembles the door. Consequently, the more overextended the previous price swing, the less the resistance or support that is required to halt it. Also, the faster a price moves on the upside, the more willing traders will be to take a quick profit. On the other hand, an abrupt move to the downside will make the price appear as that much more of a bargain than if it had slowly drifted lower. Chart 5.10 features the gold price. Note how it makes a high in January 1986 and then falls away. The subsequent rally is quite steep, then the price runs out of steam and declines again. Finally, in late July, it works its way higher in a fairly methodical acircumflex manner. This time, the same level of resistance is easily overcome because buyers are not as exhausted as they were in their March attempt. Examine the amount of time elapsed. The third rule for establishing the potency of a support or resistance zone is to examine the amount of time that has elapsed between the formation of the original congestion and the nature of general market developments during that period. A supply that is 6 months old has greater potency than one established 10 or 20 years previously. Even so, it is almost uncanny how support and resistance levels remain effective time and time again, even when separated by many years. Summary. 1. Support and resistance represent a concentration of demand and supply sufficient to halt a price move, at least temporarily. 2. They are not signals to buy or sell, but intelligent places for anticipating a reversal, and should always be used in conjunction with other indicators. 3. Potential support/resistance zones develop at previous highs and lows, round numbers, trend lines and MAs, emotional points on charts, and retracement points such as Fibonacci proportions. 4. The significance of a support or resistance zone depends upon the amount of an asset that previously changed hands in that area, the speed and extent of the previous price move, and the period of time that has elapsed since the zone was last encountered. Chapter 6. Trend Lines. Trend lines are perhaps the simplest of the tools we use in the technical arsenal and are arguably one of the most effective. Since the construction of nearly all price patterns requires the use of trend lines, this concept is a fundamental building block of pattern identification and interpretation, the subject of Chapter 8. In this chapter, we will describe trendline characteristics and explain how the significance of individual lines can be determined. A trend line is a straight line connecting either a series of ascending bottoms in a rising market or the tops of a descending series of rally peaks. Those joining the lows are called uptrend lines, and those connecting the tops are referred to as downtrend lines. It is also possible to construct horizontal trend lines joining a series of identical lows or identical highs. Typically, a downtrend line is constructed by joining the final peak with the top of the first rally, as in Figure 6.1. When the price breaks above the trend line, a trend change signal is given. The opposite is true for an uptrend line. See Figure 6.2. How to draw trend lines. In order for a line to be a true trend line, it must connect two or more peaks or troughs. Otherwise, it will be drawn in space and will have no significance. You will often see people constructing lines that only touch one point, as in Figure 6.3, or even no points at all, as in Figure 6.4. Such lines have no meaning whatsoever and are really worse than drawing nothing at all. This is because, by simply appearing on the charts, such lines give the observer the impression that they actually have some significance. It's a fundamentally important point because major technical principle. A true trend line is a graphic way of representing the underlying trend. Consequently, if it only touches one point, it cannot be true trend line. Ideally, an uptrend line is constructed by connecting the final low with the first bottom in the rally, as line AD in Figure 6.5. This is called the primary trend line. In the case of a primary trend, this would be the bear market low and the first intermediate bottom. The example shown here offers a fairly shallow angle of ascent. Unfortunately, the price rallies sharply, which means that the violation develops well after the final peak. In such situations, it is better to redraw the line as the price moves up. In Figure 6.5, this is line BC, which is obviously a better reflection of the underlying trend. This is called a secondary trend line. Downtrend lines are constructed using the same principles, but in reverse. Since trends can be sideways, it follows that trend lines can also be drawn horizontally, which is often the case when we construct price patterns such as the neckline of a horizontal head and shoulders H and S pattern, or the upper or lower boundaries rectangles, described in later chapters. In the case of price patterns, the penetration of these lines usually warns of a change in trend, as does the violation of rising or falling trend lines. It's important to understand the following principle at this point. Major technical principle. Drawing trend lines is more a matter of common sense rather than following a set of hard and fast rules. Bar versus line are close-only charts. Some charts are plotted with bars and others as line charts. The question naturally arises as to which form should be used for the purposes of trendline analysis. In most cases, bar charts offer more timely signals, whether it's a peak and trough progression, price pattern completion, or trendline violation. In technical analysis, timeliness comes with a price, and the price in this case is more whipsaws. With traditional daily or weekly charts, the closing price is very important because it sorts out the men, i.e., those who are willing to take home a position overnight or over a weekend, from the boys, i.e., those who are not. This has become less important as a factor for markets that trade for 24 hours, Sunday through Friday. However, since all markets are closed over the weekend, Friday closes continue to maintain their importance. Even so, closing prices are, for the most part, more important chart points than highs or lows. Also, since there is much excitement during the day as unexpected news breaks, highs and lows often represent random points on the chart. For this reason, it is often a better idea to construct trend lines using closing data. I'm not going to say that's always the case, because some bar trend lines have greater significance than close-only ones, based on the rules outlined for significance described later in this chapter. Thus, it is always crucial to apply common sense as much as strict technical rules. The question you should be constantly asking is, which line better reflects the underlying trend? Trendline breaks can be followed by a reversal or consolidation. The completion of a price pattern can signify either 1. A reversal in the previous trend. In this instance, it is known as a reversal pattern. Or 2. A resumption of the previous trend, when it is called a consolidation or continuation pattern. Similarly, the penetration of a trend line will result in either a reversal of that trend or its continuation. Figure 6.6 illustrates this point from the aspect of a rising price trend. In this case, the trend line joining the series of troughs is eventually penetrated on the downside. The fourth peak represented the highest point in the bull trend, so the downward violation of the trendline signals that a bear move is underway. The upward price trend and trendline penetration in Figure 6.7 are identical to those in Figure 6.6, but the action following this warning signal is entirely different. This is because the trendline violation results in the advance continuing, but at a slower rate. A third alternative is that the price consolidates in a sideways trading range and then advances, Figure 6.8. Finally, it may consolidate and then reverse to the downside. This is shown in Figure 6.9. Thus, whenever a trend line is violated, the odds strongly favor a change in trend. That change can either be an actual reversal or a sideways trading range following an uptrend or downtrend. In most instances, there is, unfortunately, no way of telling at the time of the violation which possibility will prove to be the outcome. Generally speaking, though, the violation of trend lines with a sharp angle of ascent or descent is more likely to result in a consolidation. Also, valuable clues can be gleaned by applying other techniques described in subsequent chapters, and by evaluating the state of health of the market's overall technical structure examined in Part Roman II. Using the techniques discussed in Chapter 8 can also help. For example, in a rising market, a trendline penetration may occur at the time of, or just before, the successful completion of a reversal pattern. An example is shown in Figure 6.10. Figure 6.11 illustrates the same phenomenon from the aspect of a bear market reversal. If the violation occurs simultaneously with, or just after, the completion of a reversal pattern, the two breaks have the effect of reinforcing each other. Sometimes, as in Figure 6.12, the trendline violation occurs before the completion of the pattern. In such cases, the break should be regarded as a sign of an interruption of the prevailing movement rather than one of reversal, because a trend is assumed to continue until the weight of the evidence indicates otherwise. A couple of examples of this phenomenon appear in Chart 6.1, featuring Invesco Energy Fund. This chart indicates two examples of where a trendline break and pattern completion develop close together. At the end of 1990, the Invesco Energy Fund violates a nice uptrend line and shortly after completes a right-angled broadening top. The end of the decline is signaled with another downtrend line break, and the completion of a reverse head and shoulders pattern. For a full description of these patterns, please refer to Chapter 8. Further clues to the significance of a specific trendline violation can be gleaned from volume characteristics, as described in the next chapter. For example, if a series of ascending peaks and troughs is accompanied by progressively lower volume, it is a sign that the advance is running out of steam, since volume is no longer going with the trend. In this instance, a trendline violation is likely to be of greater significance than if volume had continued to expand with each successive rally. It is not necessary for a downside penetration to be accompanied by high volume, but a violation that occurs as activity expands emphasizes the bearish undertone because of the obvious switch in the demand/supply balance in favor of sellers. Major technical principle. As a general rule, the violation of trend lines with a sharp angle of ascent or descent is more likely to result in a consolidation than a reversal. Extended trend lines. Most people observe the violation of a trend line, then assume that the trend has changed and forget about the line. This is a mistake because an extended line can become just as important as the pre-violated line itself. The difference is that an extended line reverses its role. Just as a return move often happens following a breakout from a price pattern, a similar move, known as a throwback, sometimes develops following a trendline penetration. Figure 6.13 shows a trendline reversing its previous role as support, while the throwback move turns it into an area of resistance. Figure 6.14 shows the same situation for a declining market. Chart 6.2 shows an uptrend line break for the China ETF FXI. The penetration of this line resulted in the extended line becoming resistance. Later it was penetrated again, and a subsequent decline showed it to be a level of support. Finally, two trend lines converged in early March, and since they had just been violated on the downside, they circumflex reinforced each other as a resistance zone that quickly resulted in the price moving to the downside. Major technical principle: an extended trend line reverses its support/resistance role. Logarithmic ratio, VS. Arithmetic scales scaling is an issue that is often overlooked in the technical community, but since it can have an important influence on how trend lines can be interpreted, this is as good a place as any to introduce this concept. There are two axes on any market chart. The x-axis, along the bottom, registers the date except in point and figure charting, and the y-axis, the price. There are two methods of plotting the y-axis, arithmetic and logarithmic. Which one is chosen can have very important acircumflex implications. Arithmetic charts allocate a specific point or dollar amount to a given vertical distance. Thus, in chart 6.3, each arrow has the same vertical acircumflex distance and reflects approximately 250 points. That will be true at any price level. A logarithmic scale, on the other hand, allocates a given percentage price move to a specific vertical distance. In chart 6.4, each arrow represents a move of approximately 100%, whether it is at lower prices or higher prices. There is very little noticeable difference between the scaling methods when charts are plotted over short periods of time, where price fluctuations are relatively subdued. However, with large price fluctuations, there are considerable differences. The arithmetic scale suppresses price fluctuations at low levels and exaggerates them at high points. Thus, the 85% 1929-1932 decline hardly shows up at all in chart 6.3, but the 40% late 1990s, early 2000s retreat, no small decline, is greatly exaggerated. Chart 6.4 shows that the logarithmic scaling brings back 1929 and does not exaggerate the turn of the century bear market. The media love to hype stories and news because that is what sells. You will find that charts featuring financial markets or economic numbers are almost always plotted on an arithmetic scale because this has the effect of exaggerating the most recent changes. Another hyping technique used by the media is to present the data for a short period using a very limited scale. The reader is then left with the sense of a dramatic move. This would not be the case if the data were displayed over a much longer period using a wider price scale. As you can appreciate, I am very much in favor of using a logarithmic scale because it displays price trends in a proportionate way. Psychology tends to move proportionately as well, so it makes perfect rational sense to use logarithmic scaling. Having said that, when price fluctuations are relatively small, say, over a 3-month period, there is very little difference between the two scaling methods. As a purist, though, I still prefer the log scale at all times. There is an even more important advantage of the logarithmic scale, which we shall learn when the concept of pattern price objectives is discussed later. But for now, let's consider the implications for trendline interpretation. The choice of scale is important for a timely and accurate use of trendline analysis, because at the end of a major movement, prices tend to accelerate in the direction of the prevailing trend, i.e., they rise faster at the end of a rising trend and decline more sharply at the termination of a bear market. In a bull market, prices rise slowly after an initial burst and then advance at a steeper and steeper angle as they approach the ultimate peak, looking rather like the left-hand cross-section of a mountain. Chart 6.5 shows an uptrend line break for Intel based on a logarithmic scale. Note that the downside penetration develops in mid-December. Chart 6.6 shows exactly the same period, but this time, the scaling is arithmetic. The trendline break is entirely different since it initially comes as a whipsaw in late December, followed by a valid break in mid-January. The downward pointing arrow on the left marked the logarithmic break. Thus, it is apparent that uptrend lines are violated more quickly on a logarithmic than on an arithmetic scale. Conversely, downtrend lines are violated sooner on an arithmetic scale. This can be seen from a comparison of charts 6.7 and 6.8 for IBM. Generally speaking, penetration of a logarithmically drawn trend line is more accurate in reflecting trend reversals than is penetration of an arithmetically drawn trend line. However, if the arithmetically constructed one is substantially more significant, based on the criteria listed next, then that would be the one to go with. Significance of trend lines. It has been established that a break in trend caused by the penetration of a trend line results in either an actual trend reversal or a slowing in the pace of the trend. Although it may not always be possible to assess which of these alternatives will develop, it is still important to understand the significance of a trendline penetration. The following guidelines should help in evaluation. Length of the line. The size or length of a trend is an important factor, as with price patterns. If a series of ascending bottoms occurs over a 3 to 4 week span, the resulting trend line is only of minor importance. If the trend extends over a period of 1 to 3 years, however, its violation marks a significant juncture point. Just remember, big trends result in big signals, small trends in small signals. Number of times the trend line has been touched or approached. A trend line also derives its authority from the number of times it has been touched or approached, i.e., the larger the number, the greater the significance. This is true because a trend line represents a dynamic area of support or resistance. Each successive test of the line contributes to the importance of this support or resistance, and thus the authority of the line is a true reflection of the underlying trend. Just remember that a close encounter to the line and approach is almost as important as an actual touching because it still reflects the line's importance as a support or resistance area. Also, if a line gains significance from the fact that it has been touched or approached, the extended line will become equally as important, but from a reverse point of view, since extended lines reverse their support/resistance functions. Angle of ascent or descent. A very sharp trend, as in figure 6.15, is difficult to maintain and is liable to be broken rather easily, even by a short sideways movement. All trends are eventually violated, but the steeper ones are likely to be ruptured more quickly. The violation of a particularly steep trend is not as significant as that of a more gradual one. Penetration of a steep line usually results in a short corrective movement, following which the trend resumes, but at a greatly reduced and more sustainable pace. Usually, the penetration of a steep trend line represents a continuation rather than a reversal break. Major technical principle. The significance of a trend line is a function of its length, the number of times it has been touched, and the angle of ascent or descent. Measuring implication. Trend lines have measuring implications when they are broken, just as price patterns do. The maximum vertical distance between the peak in the price and the trend line is measured during a rising trend. See figure 6.16. This distance is then projected down from the point at which the violation occurs. The opposite for an uptrend line violation is shown in figure 6.17. The term price objective is perhaps misleading. Objectives are usually reached when a trendline violation turns out to be a reversal, but because they are more often exceeded, as with price patterns, the objective becomes more of a minimum expectation. When prices move significantly through the objective, this area often becomes one of resistance to the next major rally or support for a subsequent reaction. Figures 6.18 and 6.19 show the sum of these possibilities in both a down and up market. Time and again, These price objective areas prove to be important support or resistance points. Unfortunately, there is no way to determine where the actual juncture point will be for any rally or reaction. This emphasizes a point made earlier, that there is no known way of consistently determining the duration of a price movement. It is only possible to speculate on the probability that a specific area will prove to be an important turning point. Corrective fan principle. At the beginning of a new primary bull market, the initial intermediate rally is often explosive, and so the rate of ascent is unsustainably steep. This happens because the advance is often a technical reaction to the previous overextended decline, as speculators who were caught short rush to cover their positions. As a result, the steep trend line constructed from the first minor reaction is quickly violated. This is represented as line AA in figure 6.20. A new trend line is then constructed, using the bottom of this first intermediate decline AB. The new line rises at a less rapid rate than the initial one. Finally, the process is repeated, resulting in construction of a third line AC. These lines are known as fan lines. There is an established principle that once the third trend line has been violated, the end of the bull market is confirmed. In some respects, these three rally points and trend lines can be compared to the three stages of a bull or bear market, as outlined in Chapter 3. The fan principle is just as valid for downtrends, and can also be used for determining intermediate as well as cyclical movements. Trend channels. So far, only the possibilities of drawing trend lines joining bottoms in rising markets and tops in declining ones have been examined. It is also acircumflex useful to draw lines that are parallel to those basic trend lines, as shown in figure 6.21. In a rising market, the parallel line known as a return trend line joins the tops of rallies, and during declines, the return line joins the series of bottoms, see figure 6.22. The area between these trend extremities is known as a trend channel. The return line is useful from 2 points of view. First, it represents an area of support or resistance, depending on the direction of the trend. Second, and perhaps more important, penetration of the return trend line represents a signal that either the trend will accelerate or a reversal in the basic trend is about to take place, at least temporarily. In figure 6.23, the violation of the return line signifies that the price advance has begun to accelerate. In effect, the channel in figure 6.23 represents a rising trading range, and the trendline violation is a breakout from it. Exhaustion. On the other hand, if the angle of the trend channel is much steeper, as in figures 6.24 and 6.25, the violation of the return line represents an exhaustion move. The failure of the price to hold above or below the return line then signals an important reversal in trend. This is often the case if the break through the return line is accompanied by high volume. Consider a situation in which a person is sawing a thick piece of wood. At first, the sawing strokes are slow but deliberate, but gradually, the person realizes that this task is going to take some time, becomes frustrated, and slowly increases the speed of the strokes. Finally, the person bursts into a frantic effort and is forced to give up the task, at least temporarily, because of complete exhaustion. The same principles hold true in a declining market. In this case, the expanding volume at the low represents a selling climax. As a general rule, the steeper the channel, the more likely it is that the breakout will turn out to be an exhaustion move. Exhaustion also develops when a price rallies temporarily above a regular downtrend line or below an uptrend line and then breaks back below or above it. In the case of a downtrend line, the situation is akin to someone jumping up and temporarily pushing through the ceiling. The person is able to pull their head through to the next floor for a few moments, but then falls sharply back to the floor below. At this point, he has used up all spare energy in the attempt to move to the next floor and is totally exhausted. Before he can make another attempt, he will need some time to gain some new energy. The same is true of the price, which makes an effort to rally above the trend line but is unable to maintain the breakout. This temporary break often indicates that the prevailing trend has much further to run. It also raises a dilemma concerning the way in which a trend line should be constructed. In Figure 6.26, for instance, we see a false break above trendline AB. Should AB now be abandoned, or should the peak of the exhaustion break be connected to the rally high to form a new dashed AC trendline? Again, it's a matter of common sense. On the one hand, the top of the whipsaw break is technically the correct place to draw the line, but common sense suggests that the original line is a better reflection of the underlying trend. After all, at the time of the whipsaw, it had been touched 3 times. If a new line is then drawn to reflect the break, that line will have been touched only twice, once at the outset and once at the whipsaw peak. In a sense, the whipsaw is adding further credibility to the initial line because the price was unable to hold above it. If we had come upon this acircumflex situation after the whipsaw break and tried to construct a line, it would have been even more obvious that line AB was far superior to line AC because it has been touched or approached on far more occasions. Chart 6.9 shows that a resistance trendline joining the 1974 low and 1978 highs was temporarily violated. This proved to be an exhaustion move, since the S&P composite was unable to hold above the line. This failure was followed by the 1987 crash. Not all exhaustion moves result in such dynamic consequences, but they certainly warn of potential trouble and should never be ignored. The same principles are true in reverse for an uptrend line. When you think about it, a whipsaw break actually adds credibility to the trend line. This is because the price is able to violate the line, but this line is so significant as a support/resistance area that the price is unable to hold the break. If it were not such a significant barrier, the break would have held and the whipsaw would have been avoided. Consequently, when the price is able to experience a valid break, the signal is that much stronger. Chart 6.10 shows an example of a whipsaw downside break for Microsoft in 1998. Major technical principle: exhaustion develops when a price rallies temporarily above a downtrend line or below an uptrend line and then breaks back below or above it. Summary: 1. Trend lines are perhaps the easiest technical tool to understand, but considerable experimentation and practice are required before the art of interpreting them can be successfully mastered. 2. Trendline violations signal either a temporary interruption or a reversal in the prevailing trend. It is necessary to refer to other pieces of technical evidence to determine which is being signaled. 3. The significance of trend lines is a function of their length, the number of times they have been touched or approached, and the steepness of the angle of ascent or descent. 4. A good trend line reflects the underlying trend and represents an important support and resistance zone. 5. Extended trend lines are an important concept and should not be overlooked. 6. Exhaustion breaks often possess good predictive power. Chapter 7. Basic characteristics of volume. Almost everything that technicians use in plotting a specific security involves either the price itself or a statistical variation on it. Volume can offer a new dynamic in our interpretation of crowd psychology. Therefore, analyzing volume trends gives us a better understanding of how and why price patterns work. In effect, the study of the characteristics of volume gives greater depth to the weight of the evidence approach described earlier. Volume not only measures the enthusiasm of buyers and sellers, but also is a variable that is totally independent of price. In this chapter, we will discuss some general principles of volume interpretation, and in Chapter 26, some individual volume indicators. We are beginning our volume coverage at this point, as it is a basic building block of price patterns, in a similar way to the concepts of support and resistance, peak and trough analysis, and trend lines. At the end of this chapter, all the basic building blocks will have been covered, leaving us prepared to tackle the subject of price patterns head-on. Benefits of volume studies. Volume studies offer 3 major benefits. 1. When price and volume patterns are compared, it is important to see whether they are in agreement. If so, the probabilities favor an extension of the trend. 2. If price and volume disagree, this tells us that the underlying trend is not as strong as it looks on the surface. 3. Occasionally, price action offers mild signs of an impending trend reversal, but volume can throw up characteristics of its own that literally shout this message. In such cases, a study that was limited to price action would fail to uncover a really good and obvious warning or opportunity. Principles of volume interpretation. 1. The first and most important principle is that volume typically goes with the trend. It is normal for activity to expand in a rising market and to contract in a declining one. See Figure 7.1. In this sense, volume is always interpreted in relation to the recent past. Comparing 21st century 1 billion plus share days on the New York Stock Exchange, NYSE, with early 20th century levels of 5 or 6 million is of little help. Such a comparison reflects institutional, not psychological changes. Volume is higher today because of more companies being listed, the advent of derivatives, lower commissions, and so forth. On the other hand, a 3 billion share day this week compared to a recent 1.5 billion share day last month is relevant, because it shows a significant change in activity over a period in which major institutional changes will be non-existent. We know that when prices move in trends, this does not occur in a straight line. Instead, the price works its way up and down in a zigzag fashion. Volume trends are similar. On the left side of Figure 7.2, for instance, the solid arrows indicate an expanding volume trend and the dashed ones declining trends. It is apparent that the level of activity does not expand in every period. There are quiet periods and active ones, but the general thrust is up. It, too, is irregular. When we talk about volume rising or falling, we are usually referring to its trend. It is normal for such trends to be interrupted by aberrations in volume levels. Volume trends, like price trends, can be intraday, short, intermediate, or long, depending on the nature of the chart. The amount of money flowing into a security must always equal the amount of money flowing out. This is true regardless of the level of volume. Consequently, it is the degree of enthusiasm of buyers or sellers that determines the course of prices. If buyers are bullish, they will raise their bids until their demands are satisfied. If sellers react to bad news, they may panic, pushing prices down sharply. But at all times, the amount of a security being sold is equal to that being purchased. 2. The combination of rising volume and rising price is normal. It indicates that things are in gear. Such a state of affairs has no forecasting value, except to imply that it is likely that a negative divergence between price and volume lies ahead. 3. Volume normally leads price during a bull move. A new high in price that is not confirmed by volume should be regarded as a red flag, warning that the prevailing trend may be about to reverse. In Figure 7.3, the price peaks at point C, yet the average volume reached its maximum around point A. Such action is normal. The declining volume peaks warn of underlying technical weakness. Unfortunately, there are no hard and fast rules about how many divergences precede a peak. Generally speaking, though, the greater the number of negative divergences, the weaker the underlying technical picture. Also, the lower the peaks relative to each other, the less enthusiasm is being generated and the more vulnerable the technical position becomes. Once buying dries up or selling enthusiasm intensifies. A new high that is accompanied by virtually no volume is just as bearish as a new price high with virtually no upside momentum. An example is shown in Chart 7.1 for Allegiant Technology, where you can see that the volume clusters gradually become smaller as the price rallies. Eventually, this negative technical characteristic is confirmed as the price violates the 2010-2011 uptrend line in early July 2011. 4. Rising prices accompanied by a trend of falling volume, Figure 7.4, is an abnormal situation. It indicates a weak and suspect rally and is a bear market characteristic. When it is recognized, it can and should be used as a piece of evidence pointing to a primary bear market environment. Volume, a circumflex, measures the relative enthusiasm of buyers and sellers. When it shrinks as prices rise, the advance occurs because of a lack of selling rather than because of sponsorship from buyers. Sooner or later, the trend will reach a point where sellers become more motivated. After that, prices will start to pick up on the downside. One clue is provided when activity increases noticeably as the price starts to decline. This is shown in Figure 7.5, where you can see that volume starts to pick up as the price starts a sell-off. In such situations, it is not necessary for volume to expand throughout the decline, as it does in this example. It could be that it picks up for 2 or 3 bars just after the peak. In fact, this would be a more typical situation. Figure 7.6 shows how the volume configurations change between a bull market and a bear market. Chart 7.2 shows the final rally being accompanied by a trend of declining volume for cores. When the lower trend line is violated, volume picks up noticeably. In this instance, we have one bearish volume configuration that is instantly followed by another. Chart 7.3 shows several bear market rallies in which the rising price trend is accompanied by declining volume for Radio Shack. 5. Sometimes both price and volume expand slowly, gradually working into an exponential rise with a final blow-off stage. Following this development, both volume and price fall off equally sharply. This represents an exhaustion move and is characteristic of a trend reversal, especially when supported by a 1 or 2 bar price pattern discussed in subsequent chapters. The significance of the reversal will depend upon the extent of the previous advance and the degree of volume expansion. Obviously, an exhaustion move that takes 4 to 5 days to develop will be nowhere near as significant as one that develops over a matter of weeks. This phenomenon is termed a parabolic blow-off and is featured in Figure 7.7. Unfortunately, exhaustion, or blow-off, moves such as this are not easy to define in the sense that it is possible to construct clearly definable trend lines or price patterns. For this reason, it is usually not possible to spot the terminal phase until a period or so after volume and price have reached their crescendos. Furthermore, because of their nature, parabolic blow-offs are quite rare. Chart 7.4 uses Newmont mining to demonstrate a classic example of an exponential increase in both price and volume that ends in tears in the form of an abrupt reversal in late September 1987. We see another in Chart 7.5 featuring AMREP Ordinary. 6. A selling climax is the opposite of a parabolic blow-off. It occurs when prices fall for a considerable time at an accelerating pace, accompanied by expanding volume. Prices typically rise after a selling climax. The low that is established at the time of the climax is unlikely to be violated for a considerable time. I emphasize the word unlikely because there are no guarantees, just a strong probability. Clearly, a selling climax is likely to be more of an indication of a final short or intermediate term bottom in a bull market. A price rise from a selling climax is by definition accompanied by declining volume. This is the only time when contracting volume and a rising price may be regarded as normal. Even so, it is important to make sure that volume expands on subsequent rallies, as indicated in Figure 7.8. The termination of a bear trend is often, but not always, accompanied by a selling climax. Unlike parabolic blow-offs, which are quite rare, selling climaxes appear on the charts far more often and are, therefore, quite a common technical phenomenon. In Chart 7.6, we see a selling climax develop in 2010 for Anadarko Petroleum. This is then followed by a rally and a subsequent test on lower volume. Note how volume declines on the rally, a perfectly normal characteristic following a selling climax. 7. When prices advance following a long decline and then react to a level at, slightly above, or marginally below the previous trough, this is a bullish sign if the volume on the second trough is significantly lower than the volume on the first. There is an old saying on Wall Street, "Never short a dull market." This saying applies very much to this type of situation, in which a previous low is being tested with very low volume. Such a situation indicates a complete lack of selling pressure. See Figure 7.9. 8. A downside breakout from a price pattern, trend line, or moving average MA that occurs on heavy volume is abnormal and is a bearish sign that confirms the reversal in trend, Figure 7.10. When prices decline, it is usually because of a lack of bids, so volume contracts. This is normal activity and does not give us much information. However, when volume expands on the downside, it is because sellers are more motivated, so the decline, other things being equal, is likely to be more severe. 9. When the price has been rising for many months, an anemic rally, figure 7.11, accompanied by high volume, indicates churning action and is a bearish factor. An example featuring Dresser Industries is shown in chart 7.7. 10. Following a decline, heavy volume with little price change is indicative of accumulation and is normally a bullish factor, figure 7.12. 11. Record volume coming off a major low is usually a very reliable signal that a significant bottom has been seen. This is because it indicates that an underlying change in psychology has taken place. Such reversals in sentiment are usually of a primary trend magnitude. Examples in the U.S. stock market developed in March 1978, August 1982 and 1984, and October 1998. A similar pattern also developed at the 1987 low in bonds and eurodollars. This is not an infallible indicator, though, because record volume was achieved in January 2001 for both the NYSE and Nasdaq, yet this did not turn out to be the final low for the bear market, which was achieved over a year later in October 2002. 12. When volume and price expand at a sharp pace, but short of a parabolic blow-off, and then contracts slightly, this usually indicates a change in trend. Sometimes this is an actual reversal, and at other times a consolidation. This phenomenon is featured in figure 7.13 and represents a temporary exhaustion of buying power. It is associated with several 1 and 2 bar price patterns discussed in later chapters. The example shows the price eventually selling off, but it could just as easily have risen. All the volume crescendo is telling us is that buyers are exhausted and we should expect a pause. When that buying is exceptionally heavy, a more bullish extreme in sentiment is indicated and is more likely to be followed by an extended period of price erosion, as shown in figure 7.13. 13. When the price experiences a small rounding top and volume experiences a rounding bottom, this is a doubly abnormal situation since price is rising and volume is falling as the peak is reached. After the peak, volume expands as the price declines, which is also abnormal and bearish. An example is shown in figure 7.14. An example featuring Microsoft is featured in chart 7.8. Note how the letter N characterizes the price action, whereas the volume configuration is closer to letter U. 14. When the price volatility shrinks to almost nothing and volume does the same, this indicates total disinterest. When the situation is eventually resolved, this is often followed by an above-average price move. In figure 7.15, for instance, price and volume fall to the kind of levels where the slightest movement in either direction will signal a dramatic price movement. In this case, the downtrend line is violated on the upside and volume explodes. So too do prices. Generally speaking, the quieter the price and volume action relative to the preceding downtrend, the more explosive the confirmed subsequent rally is likely to be. In this case, confirmed means some kind of a price trend reversal accompanied by expanding volume. A very narrow balance between buyers and sellers is certainly apparent in chart 7.9, which features Isaac Bank. Note the shrinking volatility of the price activity and the accompanying trend of lower and lower volume. The balance between buyers and sellers is extremely fine as we roll into early September. Then the price breaks to the downside and volume expands. That's the signal for an above-average price decline. None of the indicators used in the technical arsenal are guaranteed to work every time. This is certainly true of volume characteristics. However, when volume is used in combination with price characteristics in pattern interpretation, trendline violations, and moving average crossovers, it greatly enhances the probability that a specific setup or formation will work. As we discuss specific price examples in subsequent chapters, The basic volume principles described here will be expanded to suit individual cases. You will also be able to appreciate at this point that most of the time volume as an indicator is not telling us very much. However, when it does speak and is confirmed by other indicators, a loud message is indeed given. Summary. 1. Volume is a totally independent variable from price. 2. It is normal for volume to go with the trend. When these characteristics are present, they have little forecasting value. 3. When volume trends are moving in a direction opposite to that of price, this is abnormal and either warns of an impending trend reversal or emphasizes the significance of any breakout. 4. Volume trends experience exhaustion phenomena. These are called parabolic blow-offs at tops and selling climaxes at lows. Chapter 8. Classic Price Patterns. In earlier chapters, we discussed the concepts of peak and trough progression, support and resistance, trend lines, and rudimentary volume characteristics. These are all basic building blocks of price pattern construction. Now it's time to put them all together to gain a better understanding of how we recognize, interpret, and appreciate the significance of specific formations. For a more complete, in-depth discussion of price patterns, their underlying psychology and significance, please refer to Martin Pring on Price Patterns, McGraw-Hill, 2005. The concept of price patterns is demonstrated in Figures 8.1 and 8.2. Figure 8.1 represents a typical market cycle in which there are three trends: up, sideways, and down. The sideways trend is essentially a horizontal or transitional one, which separates the two major market movements. Sometimes, a highly emotional market can change without warning, as in Figure 8.2, but this rarely happens. Consider a fast-moving train, which takes a long time to slow down and then go into reverse. The same is normally true of financial markets. To the market technician, the transitional phase has great significance because it marks the turning point between a rising and a falling market. If prices have been advancing, the enthusiasm of the buyers has outweighed the pessimism of sellers up to this point, and prices have risen accordingly. During the transition phase, the balance becomes more or less even until finally, for one reason or another, it is tipped in a new direction as the relative weight of selling pushes the trend of prices down. At the termination of a bear market, the reverse process occurs. Major technical principle: transitions between a rising and a falling trend are often signaled by identifiable trading ranges known as price patterns. These transition phases are almost invariably signaled by clearly definable price patterns or formations, whose successful completion alerts the technician to the fact that a reversal in trend has taken place. This phenomenon is illustrated in Figure 8.3, which shows the price action at the end of a long rising trend. As soon as the price rises above line BB, it is in the transitional area, although this is apparent only sometime after the picture has developed. Once into the area, the price rises to line AA, which is a resistance area. The word resistance is used because, at this point, the price shows opposition to a further rise. When the demand/supply relationship comes into balance at AA, the market quickly turns in favor of the sellers because prices react. This temporary reversal may occur because buyers refuse to pay up for a security, or because the higher price attracts more sellers, or for a combination of these two reasons. The important fact is that the relationship between the two groups is temporarily reversed at this point. Following the unsuccessful assault on AA, prices turn down until line BB, known as a support level, is reached. Just as the price level at AA reversed the balance in favor of the sellers, so the support level BB alters the balance again. This time, the trend moves in an upward direction, for at BB, prices become relatively attractive for buyers who miss the boat on the way up, while sellers who feel that the price will again reach AA hold off. For a while, there is a standoff between buyers and sellers within the confines of the area bounded by lines AA and BB. Finally, the price falls below BB, and a major new downward trend is signaled. To help explain this concept, The contest between buyers and sellers is like a battle fought by two armies engaged in trench warfare. In Figure 8.4, Example A, armies A and B are facing off. Line AA represents Army A's defense, and BB is Army B's line of defense. The arrows indicate the forays between the two lines as both armies fight their way to the opposing trench, but are unable to penetrate the line of defense. In the second example, Army B finally pushes through A's trench. Army A is then forced to retreat and make a stand at the second line of defense, line AA2. In the markets, line AA represents selling resistance, which, once overcome, signifies a change in the balance between buyers and sellers in favor of the buyers, so that prices will advance quickly until new resistance is met. The second line of defense, line AA2, represents resistance to a further advance. On the other hand, Army B might quite easily break through AA2, but the further it advances without time to consolidate its gains, the more likely it is to become overextended, and the greater is the probability of its suffering a serious setback. At some point, therefore, it makes more sense for this successful force to wait and consolidate its gains. If prices extend too far without time to digest their gains, they, too, are more likely to face a sharp and seemingly unexpected reversal. Introducing the rectangle. The transitional or horizontal phase separating rising and falling price trends discussed earlier is a pattern known as a rectangle. This corresponds to the line formation developed from Dow theory. The rectangle in a circumflex Figure 8.5, marking the turning point between the bull and bear phases, is termed a reversal pattern. Reversal patterns at market tops are known as distribution areas or patterns, where the security is distributed from strong, informed acircumflex participants to weak, uninformed ones. And those at market bottoms are called accumulation patterns, where the security passes from weak, uninformed participants to strong, informed ones. In Figure 8.6, we see a completed pattern with a victory for the buyers as the price pushed through line AA. Note that, as the price moves through AA, the series of declining peaks and troughs reverses to one of rising peaks and troughs. On the other hand, in Figure 8.7, the price breaks to the upside, reinforcing the series of rising peaks and troughs that precede the formation of the rectangle, thereby reaffirming the underlying trend. In this case, the corrective phase associated with the formation of the rectangle would temporarily interrupt the bull market. Such formations are referred to as consolidation or continuation patterns. An example of a bearish continuation rectangle is shown in Chart 8.1 for the copper price and Chart 8.2 for the Dow Jones Rail Average. During the period of formation, there is no way of knowing in advance which way the price will ultimately break. Therefore, it should always be assumed that the prevailing trend is in existence until it is proved to have been reversed. Figure 8.8 shows an example of a continuation rectangle that develops in a downtrend. Size and depth. The principles of price pattern construction and interpretation can be applied to any time frame, right from 1-minute bars all the way through to monthly or even annual charts. However, the significance of a price formation is a direct function of its size and depth. Major technical principle: the longer a pattern takes to complete, and the greater the price fluctuations within it, the more substantial the following move is likely to be. Thus, a pattern that shows up on a monthly chart is likely to be far more significant than one plotted with intraday data and so forth. It is just as important to build a strong base from which prices can rise as it is to build a large, strong, deep foundation upon which to construct a skyscraper. In the case of financial market prices, the foundation is an accumulation pattern that represents an area of indecisive combat between buyers and sellers. The term accumulation is used because market bottoms always occur when the news is bad. In markets, such an environment stimulates sales by uninformed investors who are not expecting developments to improve. During an accumulation phase, more sophisticated investors and professionals would be positioning or accumulating the asset, concerned in anticipation of improved conditions for the security in question 6 to 9 months ahead. During this period, the security in question is moving from weak, uninformed traders or investors into strong and knowledgeable ones. At market tops, the process is reversed, as those who were accumulating at or near the bottom sell to less sophisticated market participants, who become more and more attracted as prices rise. For equities, this might develop because business conditions improve and forecasts for the economy are revised upward. Thus, the longer the period of accumulation, the greater the amount of a security that moves from weak into strong hands, and the larger is the base from which prices can rise. The reverse is true at market tops, where a substantial amount of distribution inevitably results in a protracted period of price erosion or base building. Major technical principle: the longer the formation of any pattern takes, and the more often it fails to break through its outer boundaries, the greater is the significance of the ultimate penetration. The time taken to complete a formation is important because of the amount of an asset changing hands, and also because a movement in price beyond the boundaries of a pattern means that the balance between buyers and sellers has altered. When the price action has been in a stalemate for a long time and investors have become used to buying at one price and selling at the other, a move beyond either limit represents a fundamental change, which has great psychological significance. A great example of a very long rectangle is shown in chart 8.3 for the CRB composite. There was every probability that a breakout from such a pattern would be followed by a good move, but there was no indication that prices would rise so sharply over such a brief period of time. The depth of a formation also determines its significance. Consider the trench warfare analogy once more. If the opposing trenches are very close together, say, within 100 yards, this means that the victorious assault, when it comes, will be less significant than if the armies are separated by several miles. For in that case, the battles will have been much more intense and the victory that much greater. The same is true in the financial markets. The breaching of a wide trading range has far greater psychological significance than does a narrow one. Measuring implications. Most of the results obtained with technical analysis procedures do not indicate the eventual magnitude of a trend. Price patterns are the exception, since their construction offers some limited forecasting possibilities. Pretty well all price patterns obtain measuring objectives from their depth. The rectangle is no exception. Figure 8.9 shows a rectangle that has formed and completed a distribution top. The measuring implication of this formation is the vertical distance between its outer boundaries, i.e., the distance between lines AA and BB projected downward from line BB. In many cases, the price trend will extend beyond the objective. In really strong moves, it will travel in multiples of it. We can take the process a step further by stating that the various multiples of the objective itself can become important potential support and resistance areas in their own right. Time and again, these price objective areas turn out to be important support or resistance points. Unfortunately, there is no way to determine where the actual juncture point will be for any rally or reaction. This emphasizes the principle that in technical analysis, there is no known way of consistently determining the magnitude of a price movement. It is only possible to speculate on the probability that a specific area will prove to be a support or resistance zone. Consequently, while this measuring formula offers a rough guide, it is usually a minimum expectation. Having established the fact that price patterns offer price objectives when completed, it is also important to revisit the options of arithmetic and logarithmic scaling covered earlier. If you recall, arithmetic scaling involves using the same vertical distance for equal point amounts, so that the difference in space between 2 and 4 is the same as that between 20 and 22. This compares to ratio or logarithmic scaling, where the same vertical distance plots the same proportionate move. Thus, for example, 1 inch might represent a 20% price move at whatever level it takes place. The importance of using logarithmic scales whenever possible is shown in figures 8.10 and 8.11. In figure 8.10, the price traced out and broke down from a rectangle. Projecting the vertical distance between 200 and 100 downward gives an objective of 0, clearly a very unlikely possibility. On the other hand, Figure 8.11 uses the same projection based on a logarithmic scale. In this case, a more realistic objective of 50 is obtained. It is important to remember that market prices are a function of psychological attitudes toward fundamental events. Since these attitudes have a tendency to move proportionately, it makes sense to plot them on a scale that reflects proportionate moves equally. Clearly, this distinction has little effect on very short-term, 2 to 6 weeks or intraday charts, but since you do not know exactly when it will, it's definitely a good idea to set your charting software to ratio as a default. If a rectangle appears as a bottom reversal pattern, the measuring rules remain consistent with the example given for the distribution formation. The only difference is that we project the objective and multiples of the objective in an upward direction, not downward. The exact same principles also apply to continuation rectangles. Figure 8.12 shows an upside breakout from a rectangle that forms during a bullish trend. Note in this case that the price does not immediately reach its upside objective, but does so after a small rally and reaction. This is why the objective is described by the term ultimate. Most people buy the breakout on the assumption that they will make more or less instant profits as the price moves straight to the objective, but that is not necessarily the case. Major technical principle: a measuring objective is a minimum ultimate objective. In many cases, the price will move beyond the objective. In really strong moves, it will move in multiples of the objective, where the various multiples or the objective itself become important support and resistance areas. Confirmation of a valid breakout. Price. So far, it has been assumed that any move out of the price pattern, however small, constitutes a valid signal of a trend reversal or resumption if the pattern is one of consolidation. Quite often, misleading moves known as whipsaws occur, so it is helpful to establish certain criteria to minimize the possibility of misinterpretation. Conventional wisdom holds that you should wait for a 3% penetration of the boundaries before concluding that the breakout is valid. This filters out a substantial number of misleading moves, even though the resulting signals are less timely. This approach was developed in the first part of the 20th century, when holding periods for market participants were much longer. Today, with the popularity of intraday charts, 3% could represent the complete move, and then some. I have no basic objection to the 3A circumflex euros% rule for longer-term price movements in which the fluctuations are much greater. However, the best approach is a common-sense one based on experience and judgment in each particular case. It would be very convenient to be able to say that anything over a specific percentage amount represents a valid breakout, but unfortunately, a lot depends on the time frame being considered and the volatility of the specific security. For example, electric utilities are very stable in their price action compared to mining stocks, where the volatility is far greater. Applying the same percentage breakout rule to both obviously doesn't make sense. What constitutes a decisive breakout, where the odds of a whipsaw are considerably reduced, is then very much a matter of personal judgment based on experience, trial, and error. This judgment should take into consideration such factors as the type of trend being monitored, the volatility of the security, volume, and momentum characteristics. Another factor that can help early on in deciding if a breakout is valid is the fact that a good breakout should hold for several periods. For example, you may observe a decisive upside breakout from a rectangle on a daily chart, but if it cannot hold for more than one day above the breakout level, the signal is highly suspect. Often, the technical position is worse after such breakouts, because breakouts that cannot hold indicate exhaustion, and exhaustion moves are often followed by strong price trends in the opposite direction to that indicated by the false breakout. On entering any trade or investment based on a price pattern breakout, it is important to decide ahead of time what type of price action would cause you to conclude that the breakout was a whipsaw. In effect, this will be below a support level for an upside breakout and below a resistance zone for a downward one. For this, you can draw on the information contained in Chapter 5 on support and resistance. An example of a false upside breakout might be a penetration of a previous minor low, a decline below a predetermined level from the breakout point, or the rupture of a minor uptrend line. Some possibilities are featured in Figure 8.13. A stop should then be placed below the support level. In this way, you will have calculated the loss you are willing to undertake and the point where the original premise for the trade, i.e., the breakout, is no longer operative. Failure to make such a decision ahead of time will mean that your decision to sell is more likely to be based on emotion and knee-jerk reactions to news events than on a logical preset plan. Retracement moves. A great deal of the time, when the price breaks out from a pattern, the initial thrust is followed by a corrective move back to the upper or lower reaches of the formation, depending on the direction of the breakout. This is known as a retracement move, and it offers an additional entry point, often under substantially less emotional conditions. The retracement serves two functions. First, it helps to correct the excessive emotion associated with the breakout and brings people back to earth. From here, it is then possible for the new trend to extend on a sounder basis. Second, it acts as a test of the breakout. A downside retracement will find support at the breakout point, and an upside retracement will find resistance in the lower boundary of the pattern, as these two zones reverse their former roles. Retracements, then, represent normal price behavior, and although they can be frustrating, are nothing to get concerned about. Indeed, the breakout itself is often a volatile, illiquid affair, as one side or the other heads for the entrance or exit, depending on its direction. As a result, orders are often executed with horrendous fills. Price activity during the retracement process, on the other hand, is relatively quieter. This means that buying or selling can be undertaken in a much more controlled environment. Figure 8.14 shows that it is often a good idea to wait for a retracement in a rising trend and buy as the price signals that the retracement is over. Cancellations. If the minimal objective proves to be the ultimate extension of the new trend, a substantial amount of accumulation or distribution, whichever is appropriate, will typically have to occur before prices can move in their previous direction. Thus, a 2-year rectangle might be completed and the downward price objective reached. Even though further price erosion does not take place, it is still technically necessary for a base accumulation of approximately the same size as the previous distribution, in this case, 2 years, to be formed before a valid uptrend can take place. An example is shown in Figure 8.15, where an upside breakout is canceled by a downside one. The word technically has been emphasized because that is not always the case, and there are lots of examples where large distribution formations have been canceled by small ones and vice versa. That means if you can spot a cancellation, pay attention to the signal and look around at the other indicators to see if they agree. If so, go with the cancellation, as it's probably telling the truth. Volume considerations. So far, we have just considered price in our analysis, but volume is an important independent variable that can help us obtain a more accurate reflection of crowd psychology. To quickly recap, volume typically goes with the trend, i.e., it expands with a rising trend of prices and falls with a declining one. This is a normal relationship, and anything that diverges from it should be considered a warning sign that the prevailing price trend may be in the process of reversing. Volume is always measured in relation to the recent past. Thus, heavy volume relates to volume 20 to 30 bars or so ago, not to volume, say, 10 years ago, where institutional changes may have permanently increased the level of activity. Major technical principle: volume is always measured relative to its recent past. In the case of the rectangle, and with most other patterns, it is normal for the trend of volume to contract as the formation develops. Activity may continue to fluctuate along with the price, but with the benefit of hindsight, we would expect to see the various peaks and troughs of volume shrink as the pattern develops, along the lines of Figure 8.16. As it nears completion, disinterest prevails and volume often dries up. The quality of an accumulation formation is certainly improved if volume expands on the upside break. Sometimes, it is even possible to draw a trend line joining the lower volume peaks, as shown in Figure 8.16. It is this upward surge in trading activity that confirms the validity of the breakout, because it flags the enthusiasm of buyers. A similar move on low and declining volume would be suspect and would result in its failure to move with the trend. An example is shown in Figure 8.17. In this instance, volume definitely declines as the price is breaking out. Such action typically signals that prices are advancing more on a lack of sellers than strong, enthusiastic buyers. As the price starts to slip, volume picks up noticeably, suggesting that this is happening because of selling pressure. It is a definite sign that increases the possibility that the breakout is a whipsaw. In many instances, you will see charts where successful upside breakouts develop with no obvious change in activity, either on the upside or downside. Unfortunately, this is a fact of life. Thus, a good volume expansion is a desirable but not necessarily a mandatory condition for a valid breakout. It certainly increases the odds, but other indicators such as oscillators could also tip the balance. If volume declines on the breakout, as in Figure 8.17, this is more than a missing piece of positive evidence and is, actually, a negative factor. Figure 8.18 shows a downside breakout from a rectangle. The same shrinking volume characteristics during the development of the pattern are present as for the bullish variety. However, volume characteristics on the breakout are less critical. This is because it is normal for it to contract as prices decline. Thus, contracting volume on a breakdown is perfectly normal. What is not typical, though, is for it to expand on a downside move. This in itself suggests that sellers are more motivated and therefore adds a negative flavor to the pattern. More often than not, prices will reverse and put on a small recovery or retracement rally following the downside breakout, Figure 8.19. This advance is invariably accompanied by declining volume, which itself reinforces the bearish indications. It is halted at the lower end of the rectangle, which now becomes an area of resistance. The same idea of declining volume should accompany a retracement move that follows an upside breakout. Figure 8.20 shows an example where both price volatility and volume shrink dramatically. This combination indicates an extremely fine balance between buyers and sellers that takes place over an extended period. Normally, a price objective is determined by the depth of the formation. In this case, though, the finely balanced supply/demand situation is usually followed by a far greater and sharper move than that indicated by the normal measuring techniques. Figure 8.20 dramatizes a sharp downside breakout, but the principle of rapidly declining volume followed by a huge expansion applies equally as well to an upside breakout. In this instance, volume typically explodes as we move from a situation in which there is virtually no interest by either party to one in which buyers cannot get enough of the security at any price. Such are the ingredients for the start of a dramatic rally. An example is shown in Chart 8.4 of the U.S. traded St. Jude Medical, where a very narrow rectangle developed with a dramatic drop in volume. When activity expanded, a short but sharp rally followed. Finally, Chart 8.5 features Moser Bear, an Indian stock that shows the formation of a rectangle top. It meets the minimum requirement of trendline touches, so the lines as support or resistance areas are not that significant in themselves. During the formation of the rectangle, the odd day experienced an expansion in volume, but the overall trend is a declining one. The fact that prices fell so sharply after the breakout is testament to the fact that volume does not necessarily have to expand on the downside. Prices can just as easily fall due to a lack of bids. Note also that while the price almost reached 3 times its objective, the level of the actual objective, A, became a resistance area on the way back up. Consequently, it's always a good idea to measure for these objectives at the outset, because you can never be sure where prices might find timely reversal points. A lot of the time, we find price moves following breakouts from consolidation patterns to be quite substantial, often more so than from reversal patterns. That's because reversal patterns need to build up some momentum, whereas momentum was already in place prior to the formation of the consolidation pattern. Major technical principle: volume usually leads price. Head and shoulders. Head and shoulders as reversal patterns. At tops, head and shoulders H and S are probably the most reliable of all chart patterns. They occur at both market tops and market bottoms. Figure A circumflex Euros 8.21 shows a typical head and shoulders distribution pattern. See also chart 8.6. It consists of a final rally, the head separating two smaller, although not necessarily identical, rallies, the shoulders. If the two shoulders were trends of intermediate duration, the first shoulder would be the penultimate advance in the bull market, and the second the first bear market rally. The head would, of course, represent the final intermediate rally in the bull market. Volume characteristics are of critical importance in assessing the validity of these patterns. Activity is normally heaviest during the formation of the left shoulder and also tends to be quite heavy as prices approach the peak. The real tip-off that an H and S pattern is developing comes with the formation of the right shoulder, which is invariably accompanied by distinctly lower volume. Quite often, the level of volume contracts as the peak of the right shoulder is reached. The line joining the bottoms of the two shoulders is called the neckline. If you look carefully at figure 8.21, you will appreciate that the violation of the neckline also represents a signal that the previous series of rising peaks and troughs has now given way to at least one declining peak and trough. The right shoulder represents the first lower peak and the bottom of the move following the breakdown, a lower trough. The measuring formula for this price formation is the distance between the head and the neckline projected downward from the neckline, as shown in figure 8.21. It follows that the deeper the pattern, the greater its bearish significance once it has been completed. Sometimes, a head and shoulders completion will be followed by a fairly extensive downtrend. At other times, the negative effect of the pattern will be quickly canceled by the completion of a base. Often, traders will observe the formation of a head and shoulders top and anticipate a breakdown. This is an incorrect tactic based on this evidence alone, because it is not known until later whether the prevailing trend will continue, or if a reversal signal will be given with a decisive break below the neckline. Over the years, I have seen many analysts who should know better forecast a bearish trend based on an incomplete head and shoulders top. Remember, in technical analysis, the prevailing trend is assumed to be in force until the weight of the evidence proves otherwise. An incomplete head and shoulders is not evidence, just a possible scenario. Moreover, since a right shoulder rally should be accompanied by a trend of shrinking volume, one that develops under the context of heavy volume provides a clue that the top will fail. H and S patterns can be formed in 10 to 15 minutes or can take decades to develop. Generally speaking, the longer the period, the greater the amount of distribution that has taken place, and therefore, the longer the ensuing bear trend is likely to be. The larger H and S formations are often very complex and comprise several smaller ones, as shown in figure 8.22. The H and S patterns illustrated in figures 8.21 and 8.22 have a horizontal neckline, but there are many other varieties, as figure 8.23 shows, all of which possess the same bearish implications as the horizontal variety once they have been completed. Chart 8.6 shows a classic H and S pattern that formed in the middle of 1928. At bottoms, figure 8.24 shows an H and S pattern at a market bottom. This is usually called an inverse H and S, a reverse H and S, or an H and S bottom. Normally, volume is relatively high at the bottom of the left shoulder and during the formation of the head. The major factor to watch for is activity on the right shoulder, which should contract during the decline to the trough and expand substantially on the breakout, see chart 8.7. That's an ideal situation, but it is surprising how many successful breakouts develop under circumstances where the volume does not expand noticeably. If it contracts on the breakout rally, that is a definite no-no and is a strong sign that the breakout is likely to fail. Like the H&S distribution patterns, the inverse accumulation H&S can have a number of variations in trendline slope, number of shoulders, etc. Usually, the more complex the formation, the greater its significance. This goes back to the idea that price formations represent battles between buyers and sellers. The more battles that take place, i.e., the greater the complexity, the more significant the new trend once the battle has been resolved. Some of these reverse head and shoulders variations are shown in Figure 8.25. H&S patterns are extremely reliable formations, and their successful completion usually gives an excellent indication of a trend reversal. H&S formations as continuation patterns. H&S and reverse H&S formations occasionally show up on the charts as continuation patterns. Measuring implications and volume characteristics are the same as for the reversal type. The only difference is that these patterns develop during a trend rather than at the end. Chart 8.8, featuring AEP Industries, shows a great example of a continuation reverse head and shoulders, complete with a huge expansion of volume just before and just after the breakout. Substantial markup phases such as this are not uncommon following these continuation formations. Head and shoulders failures. We have already established that prices are determined by crowd psychology. Individuals can and do change their minds, so can crowds and therefore markets. As a result, what might appear to be a perfectly valid head and shoulders breakout one day may well turn out to be a whipsaw the next. This is generally not the case, but any trader or investor who does not recognize the ability of markets to reverse otherwise perfectly legitimate signals is in a state of delusion. The first step is to make sure that the pattern you are following is indeed a legitimate formation. For example, the price action may exhibit all the characteristics of an H&S distribution pattern, but the price refuses to penetrate the neckline. We have already established that, until the formation is completed with a decisive break below the neckline, it is not a true pattern. This is because the neckline represents a support area, and support has not been violated. In the case of a horizontal formation, failure to penetrate the neckline also means that the series of rising peaks and troughs is still intact. Chart 8.9 features a reverse head and shoulders for Albertsons that did not work. The price rallied up to the solid neckline for a final time in mid-2002, but was unable to push through. The dashed trend line is there to indicate that the final part of the head and the potential inverse right shoulder actually formed a head and shoulders top. Often, it is possible to spot these technical situations where the glass is half full or half empty. In this case, it was half empty, and the price declined. Failures used to be fairly rare, but they now appear to be more common, which indicates the necessity of waiting for a decisive breakout on the downside, or the upside in the case of a reverse head and shoulders. They typically develop when the pattern suggests a break in the opposite direction to the then prevailing trend. Obviously, if this is the actual top or bottom, the formation will be valid. However, when a head and shoulders top forms in a bull market and does not experience a meaningful decline, this will tend to be a countercyclical signal. In fact, the very failure of the pattern may be interpreted as a sign that the prevailing dominant trend probably is still in force. There are several points in the chart where the probabilities of a valid signal sink below 50%, and those of an outright failure start to increase. Figures 8.26 and 8.27 try to address these points. Point A in Figure 8.26 represents the bottom following the break below the neckline. The next rally, which ends at B, is a perfectly typical development because retracements are a normal and indeed healthy phenomenon. The price then falls to C and something unexpected happens. Instead of A circumflex following through on the downside, as would be expected from a head and shoulders top, the price rises back to the neckline again. This is the first sign that things may not work out as expected. When the price once again rallies back above the neckline D, the odds of a failure increase. The balance tips more to the bullish side when the price moves above the downtrend line joining the head with the right shoulder E. This is probably the time to cover all shorts, since the reason for going short in the first place, i.e., The breakdown no longer exists. The nature of the trend line will have a great deal to do with the change in probabilities. For example, if the line is steep and has been touched only twice, it will have nowhere near as much significance as it would if it were shallow and had been touched several times. A refresher on trendline interpretation in Chapter 6 would be a good idea at this point. The next line of defense is the right shoulder. If the price can rally above this point F, then in some cases, it will now be experiencing a series of rising peaks and troughs. Finally, when the price moves above the head, the pattern is canceled beyond a reasonable doubt. If action on the long side is contemplated, it should be taken either when the price breaks above the trend line joining the head and the right shoulder line E, or when it breaks above the right shoulder F on heavy volume. Usually, such signals offer substantial profits in a very short period of time and are well worth acting on. Again, some common sense comes into play, for if the trend line joining the head and the right shoulder is unusually steep and has been touched only twice, it will not have the authority of a shallower trend line that has been touched or approached on numerous occasions. Inverse H and S patterns can also fail, as we see from Figure 8.27. Again, the failure is usually followed by a fairly lengthy decline as participants who bought in anticipation of an upward breakout are flushed out when the new bearish fundamentals become more widely known. Note that the line joining the head with the right shoulder is more significant in this example than that in Figure 8.26. That's because the line is shallower and has been touched on more occasions. The joint break with the neckline is also impressive and would greatly increase the odds of a failed pattern. The move below F obviously puts the issue beyond any reasonable doubt. Chart 8.10 shows a failed head and shoulders top for Andrew Corp. This one developed during a very strong linear bull market. The first indication of failure would have been given when the price broke back above the neckline after forming a small base. The clincher developed when the dashed trend line joining several rally peaks was bettered on the upside. Failed patterns are often followed by dynamic moves in the opposite direction to that indicated by the pattern. The rationale for this lies in the fact that market participants who bought or sold short, depending on the direction of the whipsaw, are caught on the wrong side of the market and are forced to liquidate. As a result, false moves should be viewed not with fear, but as an opportunity for profits. The degree of opportunity will depend on the strength of the signal and the closeness at which a realistic stop can be placed, the perceived risk. In this case, the trend line was a very strong one, and a stop could have been placed just below the low of the breakout day. Provided it was bought pretty close to the breakout point, this would have represented a very low risk, potentially high reward trade. Major technical principle: if a technical signal is going to fail, it is often because it is taking place in the opposite direction to the main trend. Double tops and bottoms. A double top consists of two peaks separated by a reaction or valley in prices. Its main characteristic is that the second top is formed with distinctly less volume than the first, see Figure 8.28 and Chart 8.11. It is normal for both peaks to form at the same price level, but it is also possible for the second peak to slightly exceed the first or to top out just a little below it. Remember, this is not an exact science but a common-sense interpretation of a battle between buyers and sellers. Minimum downside measuring implications for double tops, as shown in Figure 8.28, are similar to H and S patterns. A double bottom is shown in Figure 8.29. This type of pattern is typically accompanied by high volume on the first bottom, very light volume on the second, and very heavy volume on the breakout. Usually, the second bottom is formed above the first, but these formations are equally valid whether or not the second reaction reaches, or even slightly exceeds the level of its predecessor. Double patterns may extend to form triple tops or bottoms, or sometimes even quadruple or other complex formations. Some variations are shown in Figure 8.30. In some instances, it may be difficult to differentiate between a head and shoulders, rectangle, or triple top and bottom. That is not important. What is important is the fact that such formations represent a battle between buyers and sellers. when one side or the other wins out with a reversal in the peak/trough progression or the violation of a trend line. That's what is significant. Remember, we give these patterns specific names for identification purposes. If a formation, say, breaks in a bearish way, it does not matter what you call it. It's bearish and likely to lead to lower prices. That's really the lesson to take home. Major technical principle. Ultimately, it does not matter what you call a pattern. The important thing is whether it has bullish or bearish characteristics. The measuring implications of all these patterns are derived by calculating the distance between the peak, trough, and lower, upper end of the pattern, and projecting this distance from the neckline. Chart 8.12 shows a classic double bottom in the GIA in 1974 and 1962. Broadening formations. Broadening formations occur when a series of 3 or more price fluctuations widen out in size so that peaks and troughs can be connected with 2 diverging trend lines. The easiest types of broadening formations to detect are those with a flattened bottom or top, as shown in examples A and B in Figure 8.31. The patterns in Figure 8.31 are sometimes referred to as a right-angled broadening formation. Since the whole concept of widening price swings suggests highly emotional activity, volume patterns are difficult to characterize, though at market tops, volume is usually heavy during the rally phases. The patterns at both bottoms and tops are similar to the H and S variety, except that the head in the broadening formation is always the last to be formed. A bear signal comes with a decisive downside breakout. Volume can be heavy or light, but additional negative emphasis arises if activity expands at this point. Since a broadening formation with a flattened top is an accumulation pattern, volume expansion on the breakout is an important requirement, as shown in Example B in Figure 8.31. Examples of broadening formations are shown in Chart 8.13 for W. Granger and Chart 8.14 for the copper price. Notice how the bearish one exceeded its price objective by 3 times. That third multiple proved to be the end of the decline, following which a bullish broadening formation was formed. The power of these patterns can also be appreciated from Chart 8.14, which shows the formation of another right-angled pattern coming off the 2009 bottom. These 2 types of broadening formations can also develop as consolidation patterns. A bullish one is featured in Figure 8.32. Broadening formations occasionally fail to work. Possibilities are shown in Figure 8.33. Unfortunately, there does not appear to be a reliable point beyond which it is safe to say that the pattern has failed to operate. The best defense in such cases is to extend the diverging trend lines, i.e., the dashed lines in Figure 8.33, and await a decisive penetration by the price as confirmation. When completed, right-angled broadening formations of both the reversal and the continuation type result in a particularly dynamic move. It is almost as if they are aborted H and S formations in which the move is so powerful that there is not time to complete the right shoulder. An example of a bullish right-angled broadening formation, where the price objective was achieved multiple times, is shown in Chart 8.15 for Patni computers. A variation on the right-angled broadening formation is the broadening wedge. These patterns are similar in that they consist of 2 diverging trend lines, but instead of one of them being constructed at an angle of 90 degrees, it slopes up or down in the case of a bullish pattern, but at a smaller angle of ascent-descent, as shown in Figures 8.34 and 8.35. The measuring implications and other characteristics are identical to those of the right-angled variety. The final type of broadening formation, known as an orthodox broadening top, is shown in Figure 8.36. This pattern comprises 3 rallies, with each succeeding peak higher than its predecessor, and each peak separated by 2 bottoms, with the second bottom lower than the first. Orthodox broadening formations are associated with market peaks rather than market troughs. These patterns are extremely difficult to detect until some time after the final top has been formed, since there is no clearly definable level of support where the violation of which could serve as a benchmark. The violent and emotional nature of both price and volume swings further compounds the confusion and increases the complexity of defining these situations. Obviously, a breakout is difficult to pinpoint under such conditions, but if the formation is reasonably symmetrical, a decisive move below the descending trend line joining the two bottoms, or even a decisive move below the second bottom, usually serves as a timely warning that an even greater decline is in store. Measuring implications are similarly difficult to determine, but normally, the volatile character of a broadening top formation implies the completion of a substantial amount of distribution. Consequently, price declines of considerable proportion usually follow the successful completion of such patterns. The problem is that they are quite rare and do not show up on the charts very often. Triangles. Triangles, the most common of all the price patterns discussed in this chapter, are unfortunately the least reliable. They may be consolidation or reversal formations and fall into two categories: symmetrical and right-angled. Symmetrical triangles. A symmetrical triangle is composed of a series of two or more rallies and reactions in which each succeeding peak is lower than its predecessor, and the bottom from each succeeding reaction is higher than its predecessor. See Figure 8.37. A triangle is, therefore, the opposite of a broadening formation, since the trend lines joining peaks and troughs converge, unlike the orthodox broadening formation, in which they diverge. These patterns are also known as coils, because the fluctuation in price and volume diminishes as the pattern is completed. Finally, both price and usually volume react sharply, as if a coil spring had been wound tighter and tighter and then snapped free as prices broke out of the triangle. Generally speaking, triangles seem to work best when the breakout occurs somewhere between 1/2 and 3/4 of the distance between the widest peak and rally and the apex, as in Figure 8.38. The volume rules used for other patterns are also appropriate for triangles. Another factor that affects reliability emanates from one of the principles of determining trendline significance. While a triangle can theoretically be constructed by joining 4 turning points, 2 for each line, it follows that those lines will gain greater significance if touched or approached on more numerous occasions. Consequently, when they are eventually violated, their more formidable role as a dynamic support/resistance zone will likely result in a more trustworthy signal. Major technical principle: the more times the lines forming a triangle have been touched or approached, the greater the probability that their eventual violation will be valid. Right-angled triangles. Right-angled triangles are really a special form of the symmetrical type, in that one of the two boundaries is formed at an angle of 90 degrees, i.e., horizontal to the vertical axis. An example is illustrated in Figure 8.39. The symmetrical triangle does not give an indication of the direction in which it is ultimately likely to break, but the right-angled triangle does, with its implied level of support or resistance and contracting price fluctuations. One difficulty in interpreting these formations is that many rectangles begin as right-angled triangles. Consequently, a great deal of caution should be used when evaluating these elusive patterns. An example is shown in Figure 8.40, where a potential downward-sloping right-angled triangle in Example A develops into a rectangle in Example B. Traditionally, measuring objectives for triangles are obtained by drawing a line parallel to the base of the triangle through the peak of the first rally. This line, BB in Figure 8.41, represents the objective that prices may be expected to reach or exceed. The reverse procedure at market tops is shown in Figure 8.41, examples C and D. The same technique is used to project prices when triangles are of the consolidation variety. However, in my own experience, I have not found this method to be particularly useful. I prefer, instead, to treat the triangle as with any other pattern by calculating its maximum depth and then projecting this distance at the breakout. An example of this alternative method is shown in Figure 8.42. An example of a right-angled triangle followed by a bullish broadening formation is shown in Chart 8.16 featuring the GIA cup with a handle. This pattern has been made famous by William O'Neill and is described in his How to Make Money in Stocks, McGraw-Hill, 1995. The pattern develops as a bullish one, usually in a continuation format. Figure 8.43 shows that it takes the form of a big U, the cup, followed by a rally and a small rounding platform, the handle. The cup is typically preceded by a very strong rally, so the left side reflects aggressive profit-taking. The left part of the cup usually marks the culmination of a strong rally and is often associated with heavy volume. The bottom of the cup can take the form of a rounding bottom, as in Figure 8.43, or some ranging action, as in Figure 8.44. The next step in the development of this pattern is a rally on expanding volume, followed by a period of profit-taking in which both volume and price go quiet. Finally, the handle is completed and prices explode to the upside. If it is going to fail, the signal to look for is a break below the lower part of the handle. If the price eventually breaks above the upper level of the handle, the situation will again become bullish. Any breakouts that develop with shrinking volume, though, should be regarded with suspicion. Chart 8.17 shows a cup with a handle formation for ADC Telecom. The breakout above the handle is not accompanied by much of an expansion in volume, but the price certainly doesn't suffer. By its very nature, the cup with a handle is a consolidation formation. Since the breakout follows a shakeout move, the left part of the cup, it is often followed by a very strong rally. Summary. 1. Prices in financial markets move in trends. A reversal is characterized by a temporary period in which the enthusiasm of buyers and sellers is roughly in balance. This transitional process can usually be identified by clearly definable price patterns, which, when completed, offer good and reliable indications that a reversal in trend has taken place. 2. Until a pattern has been formed and completed, the assumption should be that the prevailing trend is still operative, i.e., that the pattern is one of consolidation or continuation. This principle is more important when the trend has been in existence for only a relatively short period, because the more mature it is, the greater the probability of an important reversal. 3. Price patterns can be formed over any time period. The longer the time required to form a pattern and the greater the price fluctuations within it, the more substantial the ensuing price movement is likely to be. 4. Measuring formulas can be derived for most types of patterns, but these are generally minimum objectives. Prices usually extend much further. 5. Price objectives represent the minimum ultimate target and are not normally achieved in one move. Usually, a series of rallies and reactions in an upside breakout is required, or reactions or retracements in a downside breakout, before the objective is reached. Chapter 9. Smaller price patterns and gaps. Most of the price patterns described in Chapter 8 can be observed in both reversal and continuation formations. The majority of the formations discussed in this chapter materialize during the course of a price trend and are, therefore, of the continuation variety. Since many of them are reflections of controlled profit-taking during an advance and controlled digestion of losses during a decline, these patterns, for the most part, take a much smaller time to form than those described in the previous chapter. They most commonly appear in the daily charts, flags. A flag, as the name implies, looks like a flag on the chart. It represents a quiet pause accompanied by a trend of declining volume, which interrupts a sharp, almost vertical rise or decline. As the flag is completed, prices break out in the same direction that they were moving in prior to its formation. Flags for both an up and a down market are shown in Figure 9.1. Essentially, they take the form of a parallelogram in which the rally peaks and reaction lows can be connected by two parallel lines. The lines move in a countercyclical direction. In the case of a rising market, the flag is usually formed with a slight downtrend, but in a falling market, it has a slight upward bias. Flags may also be horizontal. In a rising market, this type of pattern usually separates two halves of an almost vertical rise. Volume is normally extremely heavy just before the point at which the flag formation begins. As it develops, volume gradually dries to almost nothing, only to explode as the price works its way out of the completed formation. Flags can form in a period as short as 5 days or as long as 3 to 5 weeks. Essentially, they represent a period of controlled profit-taking in a rising market. The development of the flag in a downtrend is also accompanied by declining volume. This type of flag represents a formation with an upward bias in price, so the volume implication is bearish in nature, i.e., rising price with declining volume. When the price breaks down from the flag, the sharp slide continues. Volume tends to pick up as the price slips below the flag's lower boundary, but it need not be explosive. Only upside breakouts in bull markets require this characteristic. It is important to make sure that the price and volume characteristics agree. For example, the price may consolidate following a sharp rise in what appears to be a flag formation, but volume may fail to contract appreciably. In such cases, great care should be taken before coming to a bullish conclusion, since the price may well react on the downside. A flag that takes more than 4 weeks to develop should also be treated with caution because these formations are, by definition, temporary interruptions of a sharp uptrend. A period in excess of 4 weeks represents an unduly long time for profit-taking, therefore, holds a lower probability of being a true flag. Flag formations are usually reliable patterns from a forecasting point of view, for not only is the direction of ultimate breakout indicated, but the ensuing move is also usually well worthwhile from a trading point of view. Flags seem to form at the halfway point of a move. Once the breakout has taken place, a useful method for setting a price objective is to estimate the size of the price move in the period immediately before the flag formation began, and then to project this move in the direction of the breakout. In technical jargon, flags in this sense are said to fly at half-mast, i.e., halfway up the move. Since flags take a relatively short period to develop, they do not show up on weekly or monthly charts. Chart 9.1, featuring Adaptec, shows a flag together with the measuring implications as shown with the 2 dashed arrows. Pennants. A pennant develops under exactly the same circumstances as a flag and has similar characteristics. The difference is that this type of consolidation formation is constructed from 2 converging trend lines, as shown in Figure 9.2. In a sense, the flag corresponds to a rectangle and the pennant to a triangle because a pennant is, in effect, a very small triangle. The difference between them is that a triangle consists of a trading range bound by 2 converging trend lines that point in different directions. In the case of a pennant, they both move in the same direction. If anything, volume tends to contract even more during the formation of a pennant than during that of a flag. In every other way, however, pennants are identical to flags in terms of measuring implication, time taken to develop, volume characteristics, etc. Chart 9.2 features a pennant for Adobe in an up market. Note how the volume shrinks during the formation of the pattern. It then expands on the breakout. Wedges. A wedge is very similar to a triangle, in that 2 converging lines can be constructed from a series of peaks and troughs, as shown in Figure 9.3. But whereas a triangle consists of 1 rising and 1 falling line, or 1 horizontal line, the converging lines in a wedge both move in the same direction. A falling wedge represents a temporary interruption of a rising trend, and a rising wedge is a temporary interruption of a falling trend. It is acircumflex normal for volume to contract during the formation of both types of wedges. Since wedges can take anywhere from 2 to 8 weeks to complete, they sometimes occur on weekly charts, but are too brief to appear on monthly charts. Rising wedges are fairly common as bear market rallies. Following their completion, prices usually break very sharply, especially if volume picks up noticeably on the downside. The wedge and the pennant are very similar, since they both consist of converging trend lines that move in a contra-trend direction. The difference is that the breakout point of a pennant forms very close to or even right at the apex. The 2 projected lines for the wedge, on the other hand, would meet way in the future, in many instances, literally off the charts. Figure 9.4 puts us straight on this one, as you can see that the projected dashed lines for the wedge meet well after the breakout point. Compare this to the pennant, which is much more akin to a triangle. Sometimes, the difference between these two formations is hard to judge. If anything, wedges generally appear to take longer to form than pennants. As stated in the previous chapter, it really does not matter what we call these formations. The important question is whether their characteristics and volume configurations are bullish or bearish. Chart 9.3 shows a bearish wedge for Yahoo. Usually, such formations develop after a more protracted decline than that shown in the chart. However, there can be no mistaking the narrowing trading range as it was formed. The shrinking activity during the formation of the pattern and subsequent increase in volume on the breakout confirmed its bearish nature. Saucers and rounding tops. Figure 9.5 shows the formation of a saucer and a rounding top. A saucer pattern occurs at a market bottom, while a rounding top develops at a market peak. A saucer is constructed by drawing a circular line under the lows, which roughly approximates an elongated or saucer-shaped letter U. As the price drifts toward the low point of the saucer and investors lose interest, downward momentum dissipates. This lack of interest is also characterized by the volume level, which almost dries up at the time the price is reaching its low point. Gradually, both price and volume pick up, until eventually, each explodes into an almost exponential pattern. The price action of the rounded top is exactly opposite to that of the saucer pattern, but the volume characteristics are the same. As a result, if volume is plotted below the price, it is almost possible to draw a complete circle, as shown in figure 9.6. The tip-off to the bearish implication of the rounded top is the fact that volume shrinks as prices reach their highest levels and then expands as they fall. Both these characteristics are bearish and were discussed in greater detail in Chapter 7. Rounding tops and bottoms are fine examples of a gradual change over in the demand/supply balance that slowly picks up momentum in the direction opposite to that of the previous trend. Quite clearly, it is difficult to obtain breakout points for these patterns since they develop slowly and do not offer any clear support or resistance levels on which to establish a potential benchmark. Even so, it is worth trying to identify them since they are usually followed by substantial moves. Rounding and saucer formations can also be observed as consolidation as well as reversal phenomena and can take as little as 3 weeks to as much as several years to complete. Gaps. An upside gap occurs when the lowest price of a specific trading period is above the highest level of the previous trading period. A downside gap develops when the highest price for a specific trading period is below the lowest price of the previous trading period. On a daily bar chart, the trading period is regarded as a day, whereas on a weekly chart, it is a week, etc. By definition, gaps can occur only on bar charts on which intraday, weekly, or monthly prices are plotted. A gap is represented by an empty vertical space between one trading period and another. Daily gaps are far more common than weekly ones because a gap on a weekly chart can fall only between Friday's price range and Monday's price range, i.e., it has a 1 in 5 chance relative to a daily chart. Monthly gaps are even rarer, since such holes on the chart can develop only between monthly price ranges. The most common place to find gaps are on intraday charts at the open. I will have more to say on that point later. A gap is closed or filled when the price comes back and retraces the whole range of the gap. On daily charts, this process sometimes takes a few days, and at other times it takes a few weeks or months. In rare cases, the process is never completed. Major technical principle. There is an old saying that the market abhors a vacuum, which means that most gaps are eventually filled. It is certainly true that almost all gaps are eventually filled, but this is not always the case. Because it can take months or even years to fill a gap, trading strategies should not be implemented solely on the assumption that the gap will be filled in the immediate future. In almost all cases, some kind of attempt is made to fill it, but quite often, a partial filling on a subsequent test is sufficient before the price again reverts to the direction of the prevailing trend. The reason why most gaps are closed is that they are emotional affairs and reflect traders who have strong psychological motivation. We could even say excess fear or greed, depending on the direction of the trend. Decisions to buy or sell at any cost are not objective ones, which means the odds of people having second thoughts when things have cooled down are pretty high. The second thoughts in this case are represented by the closing of the gap, or at least a good attempt at closing it. Gaps should be treated with respect, but their importance should not be overemphasized. Those that occur during the formation of a price pattern, known as common gaps or area gaps, are usually closed fairly quickly and do not have much technical significance. Another type of gap which has little significance is the one that results from a stock going ex-dividend. There are three other types of gaps that are worthy of consideration: breakaway, runaway, and exhaustion gaps. Breakaway gaps. A breakaway gap is created when a price breaks out of a price pattern, as in figures 9.7 and 9.8. Generally speaking, the presence of the gap emphasizes the bullishness or bearishness of the breakout, depending on which direction it takes. Even so, it is still important for an upside breakout to be accompanied by a relatively high level of volume. It should not be concluded that every gap breakout will be valid, because the sure thing does not exist in technical analysis. However, a gap associated with a breakout is more likely to be valid than one that does not. Gap breakouts, which occur on the downside, are not required to be accompanied by heavy volume. If a gap does turn out to be a whipsaw, then this will usually be signaled sooner rather than later. Since most gaps are filled, and there is rarely a reason why you have to buy, it could be argued that it is better to wait for the price to at least attempt to fill the gap before committing money. After all, if you miss out because the price does not experience a retracement, all you have lost is an opportunity. Certainly, you will experience some frustration, but at least you will not have lost any capital. With markets, there is always another opportunity. If you have the patience and the discipline to wait for that opportunity, you will be much better off in the long run. The problem, especially in this day and age of shrinking time spans, is that most of us are not blessed with the patience and discipline that we so badly require for successful trading and investing. The danger of buying on a gap breakout is that you will get caught up in the emotions of the crowd. This buy-at-any-cost mentality is likely to result in discouragement when the price inevitably retraces to the downside as emotions calm down. The advice is not that you should never buy a gap breakout, but that you should think very carefully and mentally prepare yourself for the high probability that the price will correct, thereby placing your position temporarily underwater. Breakaway gaps that develop during the early stages of a primary bull market are more likely to be valid than those that develop after a long price advance. This is because young bull markets have a tremendous amount of upside momentum. Under such circumstances, there is less likelihood of indecisiveness being reflected in the charts in the form of retracement moves and trading ranges. On the other hand, breakaway gaps that develop at the end of a bull move are more likely to indicate emotional exhaustion, as the sold-out bulls literally give up on any possibility of being able to buy again at lower prices. The same principle in reverse applies to bear trends. In Technical Analysis of Stock Trends, CRC Press, 2012, Edwards and Maggi have a slightly different take. Their advice about whether to buy a breakaway gap rests on the volume configuration. They state that if volume is high just prior to the gap and shrinks as the price moves away from the upper part of the gap, then there is a 50-50 chance of a retracement. On the other hand, if volume expands at the upper part of the gap as prices move away from it, then the odds of a retracement or gap closing effort are substantially less. Such characteristics, they imply, should be bought into. I think this can be taken a little further by setting a three-step rule for buying breakout gaps. A theoretical example is shown in figure 9.8. First, it's important for the gap to develop at the beginning of a move, which implies that it should be preceded by at least an intermediate decline. In other words, if a gap is to represent a sustainable change in psychology, it must have some pretty bearish psychology as witnessed by the preceding decline to reverse. Second, the gap day should be accompanied by exceptionally heavy volume. This again reflects a change in psychology because the bulls are very much in control. Third, an attempt to close the gap should be made within 2 to 4 days, and the price should take out the high of the day of the gap. If an attempt to close the gap fails, so much the better. The idea of the test is that market participants have had a chance to change their bullish minds and did not. The part of the rule about the new high is really a way of determining whether the market confirms the gap following the successful test. Chart 9.4 offers two examples of this in October 1993 and, to a lesser extent, in February 1994. Continuation or runaway gaps. Runaway gaps occur during a straight-line advance or decline when price quotations are moving rapidly and emotions are running high. Either they are closed very quickly, e.g., within a day or so, or they tend to remain open for much longer periods and are not generally closed until the market makes a major or intermediate swing in the opposite direction to the price movement that was responsible for the gap. This type of gap often occurs halfway between a previous breakout and the ultimate duration of the move. For this reason, continuation gaps are sometimes called measuring gaps. See Figure 9.9, examples A and B. Chart 9.5 shows this concept in action as the measuring gap develops about halfway through the late August/September advance. Exhaustion gaps. A price move sometimes contains more than one runaway gap. This indicates that a very powerful trend is in force, but the presence of a second or third gap should also alert the technician to the fact that the move is likely to run out of steam soon. Hence, there is a possibility that a second or third runaway gap will be the final one. An exhaustion gap is, therefore, associated with the terminal phase of a rapid advance or decline, and is the last in a series of runaway gaps. See Figure 9.9 example B and Figure 9.10. One clue that an exhaustion gap may be forming is a level of volume that is unusually heavy in relation to the price change of that day. In such a case, volume usually works up to a crescendo well above previous levels. Sometimes, the price will close near the vacuum or gap and well away from its extreme reading. If the next day's trading creates an island on which the gap day is completely isolated by a vacuum from the previous day's trading, this is usually an excellent sign that the gap day was, in fact, the turning point. This indicates only temporary exhaustion, but should be a red flag that signals to highly leveraged traders that they should liquidate or cover their positions. If the gap is the first one during a move, it is likely to be a runaway rather than a breakaway type, especially if the price objective called for by a price pattern has not yet been achieved. An exhaustion gap should not be regarded as a sign of a major reversal, but merely as a signal that, at the very least, some form of consolidation should be expected. The importance of gaps as emotional points. The places where gaps start or terminate are potential pivotal points on a chart because they represent high emotion. If you have an argument with a friend and one of you shouts loudly at one point, you will both tend to remember that particular moment because it represents an emotional extreme. The same principle can be applied to technical analysis, since charts are really a reflection of psychological attitudes. Major technical principle. Gaps have the potential to become important support resistance levels that have the power to reverse short-term trends. Just as people have a tendency to revisit their emotions after a heated debate, so do prices after an emotional gap move. Gaps on intraday charts. There are really two types of opening gaps in intraday charts. The first develops as prices open beyond the trading parameters of the previous session, as in chart 9.6. I'll call these classic gaps since these are the ones that also appear on the daily charts. The second, more common gap develops only on intraday charts as the opening price of a new day gaps well away from the previous A-circumflex session's closing bar. I'll call these gaps intra-bar gaps because they only fall between two bars calculated on an intraday time frame. For example, in chart 9.7, the price opened up higher and created a gap at A. However, if you look back, you will see that the trading range of the previous day, contained within the box on the left, was not exceeded at the opening price. Thus, on a daily chart, there would have been no gap. If you are a trader with a 2 to 3 week time horizon using intraday charts, you should approach gaps in a different way than if you have a 1 or 2 day time horizon. The first category should try to avoid initiating trades at the time the gap is created. This is because almost all gaps are eventually closed. Sometimes this happens within a couple of hours, and at other times it can take 2 or 3 weeks. Consequently, if you buy on an opening gap on the upside, as in this chart, you run the risk that it will soon be closed. The problem is that you do not know whether it will be 2 days or 4 weeks. Intraday opening gaps. Intraday traders are also advised to step aside when the market opens sharply higher or lower. In the case of stocks, this is caused by an order imbalance. This means that the market makers are forced to go short so that they can satisfy the unfilled demand. They naturally try to get the price a little higher at the opening so that it will come down a little, enabling them to cover all or part of the short position. The process will be reversed in the case of a lower opening. The key, then, is to watch what happens to the price after the opening range. Normally, if prices work their way higher after an upside gap and opening trading range, this sets the tone of the market for at least the next few hours, often longer. On the other hand, if the price starts to close the gap after a few bars, then the tone becomes a negative one. In Chart 9.8, featuring the now no longer listed Merrill Lynch, there is an opening gap on the Wednesday. After a bit of backing and filling, the price gradually works its way lower throughout the day. The signal that the opening could be an aberration developed after the price slipped below trendline A. Note how the trendline proved to be resistance for the rest of the session. Thursday again sees an opening gap, but this time, there is very little in the way of a trading range since the price continues to climb. Again, the rally away from the opening bar set the tone for the rest of the day. Later, on Friday, another gap appears, but this time, the opening trading range is resolved on the downside as the price breaks below the $83 level flagged by the line. Once again, this proves to be resistance for the rest of the day. Island reversals. An island reversal is a compact trading range created at the end of a sustained move and isolated from previous price behavior by an exhaustion gap and a breakaway gap. A typical island reversal is shown in Figure 9.10 and Chart 9.9. The island itself is not usually a pattern denoting a major reversal. However, islands often appear at the end of an intermediate or even a major move and form part of an overall price pattern, such as the top or bottom of a head and shoulders H and S pattern, or an inverse H and S pattern. Islands occasionally occur as one-day phenomena, as is also shown in Chart 9.9. Summary. 1. Flags, pennants, and wedges are short-term price patterns that usually develop halfway along a sharp price movement. Their development is normally complete within 3 weeks on a daily chart, and they represent periods of quiet price movement and contracting volume. They are almost always continuation patterns. 2. Saucer formations and rounding tops are usually reversal patterns and are typically followed by substantial price movements. In both formations, volume contracts toward the center and is at its highest at either extremity. 3. A gap is essentially a vacuum or hole in a bar chart. Ex-dividend and area gaps have little significance. Breakaway gaps develop at the beginning of a move, runaway gaps in the middle of a move, and exhaustion gaps at the end. 4. The upper and lower areas of gaps represent potentially significant support and resistance areas. 5. Island reversals are small price patterns or congestion areas isolated from the main price trend by 2 gaps. They often signal the termination of an intermediate move. Chapter 10. 1 and 2 bar price patterns. The price patterns we have considered so far take some time to complete, usually at least 20 bars. They all reflect changes in the relationship between buyers and sellers, which tells us that there has been a reversal in psychology. Major technical principle 1 and 2 bar patterns reflect changes in psychology that have a very short-term influence on prices. Historically, the patterns described in this chapter were called 1 and 2 day patterns or 1 and 2 week patterns. With the advent of intraday charts, the title inside days, outside days, etc., is no longer a generic term. Therefore, I have chosen to use the term bar to refer to these patterns, since that term applies to all charts from 1-minute bars up to monthly ones. For a more in-depth discussion on these fascinating patterns, please see Martin Pring on price patterns. We have already established that a key factor influencing the significance of a pattern is its size. Since these 1 and 2 bar patterns do not take very long to form, they are, by definition, only of short-term significance. For example, a 1-day pattern would only be expected under normal circumstances to affect the price over a 5 to 15-day period. A 2-bar pattern created from 10-minute bars would influence the trend over the course of the next 50 minutes to an hour or so. Even so, the more I study these patterns, the more impressed I become with their ability to reliably signal short-term trend reversals. Major technical principle 1 and 2 bar patterns should be interpreted as shades of gray rather than as black or white because some patterns offer stronger signs of exhaustion than others. Therefore, not all are created equal. What we are doing is hunting for clues as to the degree of exhaustion being signaled by a particular reversal phenomenon. I could say the word help, for example, but if I shout it from the rooftop, you will get the message far more clearly that I need help. The same principle operates in the marketplace. For example, if the outside bar encompasses the trading range of 3 or 4 bars, it is likely, other things being equal, to be more significant than if it barely encompasses one, and so forth. There are some ground rules to bear in mind when interpreting these formations. 1. They generally reflect an exhaustion point. In the case of an uptrend, such patterns develop when buyers have temporarily pushed prices up too far and need a rest. In the case of downtrends, there is little, if any, supply because sellers have completed their liquidation. Such formations are almost always associated with a reversal in the prevailing trend. 2. In order for these phenomena to be effective, they must have something to reverse. This means that tops should be preceded by a meaningful rally and bottoms by a sharp sell-off. 3. It is important to interpret these patterns not so much from a black and white perspective, but as shades of gray, because not all of them are created equal. Some show all of the characteristics I will be describing later in a very strong way. Others will reflect just a few characteristics in a mild way. What we might call a 5-star pattern, with all the characteristics, is more likely to result in a strong reversal than, say, a 2-star pattern that has mild characteristics. It is, therefore, necessary to apply a certain degree of common sense to their interpretation, rather than jumping to an immediate conclusion that the presence of one of these patterns guarantees a quick, profitable price reversal. 4. 1 and 2 bar formations may sometimes experience retracement moves in a similar way to classic price patterns. Since the extremities of most of these formations represent emotional support/resistance areas on the chart, retracements offer lower risk entry points. Outside bars. Outside bars are those in which the trading range totally encompasses that of the previous bar. They develop after both down and up trends and represent a strong signal of exhaustion. An example of a top reversal is shown in Figure 10.1 and a bottom in Figure 10.2. Note that example B shows what the bars would look like if they were displayed as rectangles, a smaller one followed by a longer one. Several subsequent figures reflect the same idea. There are several guidelines for deciding on the potential significance of an outside bar. They are as follows. 1. The wider the outside bar relative to the preceding ones, the stronger the signal. 2. The sharper the rally reaction preceding the outside bar, the more significant the bar. 3. The more bars encompassed, the better the signal. 4. The greater the volume accompanying the outside bar relative to previous bars, the stronger the signal. 5. The closer the price closes to the extreme point of the bar away from the direction of the previous trend, the better. For example, if the previous trend was down and the price closes very near to the high of the outside bar, this is more favorable than if it closes near the low and vice versa. Some comparative examples of strong and weak outside bars are featured in Figure 10.3. When considering outside bars, or any of the other 1 and 2 bar price patterns, it is important to ask yourself the question, what is the price action of this bar telling me about the underlying psychology? Wide bars, sharp preceding rallies or reactions, and high volume all suggest a change in the previous trend of sentiment. Chart 10.1 features the summer 2012 price action for the Dow Jones Utility ETF. In this case, the signal was a strong one because the bar was extremely wide, encompassed the trading range of 3 previous sessions, and closed near its low. Finally, the price rallied above the resistance trend line during the course of the day and closed well below it, thereby offering a classic signal of exhaustion. Also note that investors had a chance to revisit their emotions during the 2-day retracement move that took place in early August. Chart 10.2 shows a weekly outside bar for the cocoa price. This time, it's the third in a series of 3 outside bars. The effect is that they reinforce each other and produce a very strong signal. In addition, notice that the final outside bar also closes above the support/resistance trend line, joining several lows. This indicated that the downside break was a whipsaw, which added even more icing to the bullish cake. Finally, Chart 10.3 features a daily chart of the Nasdaq 100. The outside bar on the left has a lot of the ingredients of a valid pattern. It is preceded by a good rally, and the bar itself is wide and encompasses several other bars. It also opened in the direction of the then prevailing trend and closed on its low. The question naturally arises as to why it failed. One explanation is that in really strong uptrends or downtrends, 1 and 2 bar pattern reversals represent contra-trend signals, and contra-trend signals often result in whipsaws. Note that in this case, the outside bar was the market's attempt to close a gap that had opened up several trading days earlier. The lower part of the bar, therefore, reached a support area. In addition, it's important to remember that we are dealing in probabilities, not certainties in technical analysis. Failures can and do exist. That's why it is always necessary to look over your shoulder and mentally rehearse where you are going to get out, should the low probability losing scenario develop. In this case, the stop would be placed above the upper point of the outside day. The second outside bar canceled out a bearish outside bar that had formed 2 days earlier. Usually, cancellations are followed by a pretty strong move, and this example was no exception as the price rallied sharply in mid to late November. Major technical principle: not all 1 and 2 bar patterns are followed by a reversal in trend. Some, for example, may be followed by a change in trend. Inside bars. Inside bars are the opposite of outside bars in that they form totally within the trading range of the preceding bar. An outside bar indicates a strong reversal in sentiment, but an inside one reflects a balance between buyers and sellers following a sharp up or down move, which is usually later resolved by a change in trend. During the period preceding the second bar of this formation, buyers or sellers have everything going their way, depending on the direction of the trend. Then a more even balance sets in during the formation of the inside bar, which then gives way to a trend in the opposite direction. Examples of inside bars are shown in figures 10.4 and 10.5. Guidelines for determining the significance of an inside bar are as follows. 1. The sharper the trend preceding the pattern, the better. 2. The wider the first bar and its immediate predecessors in relation to previous bars, the better. This brings the strong underlying momentum of the prevailing trend to a sort of climax. 3. The smaller the inside bar relative to the outside bar, the more dramatic the change in the buyer/seller balance, and therefore, the stronger the signal. 4. Volume on the inside bar should be noticeably smaller than that of the preceding bar since it indicates a more balanced situation. Chart 10.4 shows an example of an inside bar for Rockwell Collins. It is preceded by a very wide bar, which culminates the December 2011-January 2012 rally. Normally, we would expect to see that wide bar experiencing a bigger difference between a relatively low opening and a much higher close, so the small difference between them hinted at a change in balance between buyers and sellers. That was confirmed by the inside bar, for which volume and volatility were much reduced. Note also the 2 small outside bars that signaled the start and end of a small December rally. Chart 10.5 shows many technical events, including an inside bar just prior to the start of a major rally. Sometimes these characteristics develop at a time when longer-term forces are poised for a major upthrust, and that was obviously the case here, because there was no way to tell from the inside bar itself that such a robust advance would follow. Note also that the ranging action that preceded the inside bar was influenced by two outside bars at A and B. Remember, these patterns are expected to have an effect for only 5 to 10 bars, so these, which triggered 3-day rallies, came up a little short. Finally, the bearish outside bar that developed in early March 2012 possessed very strong characteristics. First, it whipsawed above the trend line, joining the two previous highs. Second, it encompassed many previous days of trading, and third, it closed near to its low. Two-bar reversal. A two-bar reversal is a classic way in which the charts signal exhaustion. These patterns develop after a prolonged advance or decline. Examples are shown in figures 10.6 to 10.8. The first bar of the formation develops strongly in the direction of the then prevailing trend. For a 5-star signal in an uptrend, we need to see the close of the bar at, or very close to, its high. At the opening of the next period, buyers come in expecting more of the same. This means the price should open very close to the high of the previous bar. However, the whole point of the two-bar reversal is that a change in psychology takes place as the bar closes slightly above or slightly below the low of the previous bar. Hence, the high expectations of participants at the opening of the bar are totally dashed at the end of the period, indicating a change in trend. To be effective, this has to be a climactic experience. This means that the two-bar reversal should contain as many of the following elements as possible. 1. It needs to be preceded by a persistent trend. 2. Both bars should stand out as having exceptionally wide trading ranges relative to previous bars. 3. The opening and closing of both bars should be close to their extremities. 4. An expansion of volume on both bars enhances the concept of a change in sentiment. 5. Heavier volume on the second bar relative to the first emphasizes the preponderance of traders acting in the direction of the new trend. 6. Since a two-bar reversal ideally should indicate an abrupt change in sentiment, ideally they should not be followed by much in the way of a retracement move. Chart 10.6 features a 5-minute bar for the S&P composite, where we see a classic pattern, with the highs and lows falling at exactly the correct points following a good rally. Note also that the second bar slightly exceeds the trading range of the first. This outside bar element adds a bearish factor to the pattern. Chart 10.7 shows a two-bar reversal at the climax of a rally in U.S. Bancorp in the fall of 2000. Note how the volume expands dramatically. Also, volume on the second day was slightly higher than that on the first, thereby providing an additional clue that the tide had turned in favor of the sellers. Finally, Chart 10.8, featuring FX Energy, shows how two-bar reversals sometimes form as whipsaws, where the closing of the initial bar and the opening of the second one temporarily move through a support or resistance level. In Chart 10.8, this happens to be resistance, as all those who went long during the formation of the two-bar reversal are trapped below the resistance trend line. This kind of situation is typically followed by an above-average decline and vice versa with a downside whipsaw. These 1 and 2 bar price patterns generally have an effect for a very short period of time. They are not, therefore, suitable for long-term investors. However, for traders who are looking for clear-cut entry and exit points, they can be of immense value. Key reversal bars. A key reversal bar is one that develops after a prolonged rally or reaction. Often, the trend will be accelerating by the time the price experiences the key reversal bar. The classic pattern has the following characteristics. 1. The price opens strongly in the direction of the prevailing trend. 2. The trading range is very wide relative to the preceding bars. 3. The price closes near or below the previous close, or near or above the previous close in a downtrend reversal. 4. Volume, if available, should be climactic on the key reversal bar. Examples of key reversal bars are featured in figures 10.9, 10.10, and 10.11. In many cases, A retracement move follows a key reversal bar, especially if the initial reversal in trend is unduly sharp. Normally, the extreme point of the reversal bar is not exceeded. Chart 10.9 shows a classic example in the left part of the chart, as the short-term rally is climaxed by an explosion of volume and a wide key reversal bar. Quite often, a key reversal is followed by a sharp change in trend and a subsequent retracement. That is exactly what happened in this case as the price rallied in the fourth and fifth session following the key reversal. Note that the termination of this brief advance was signaled by an outside bar. The second example of a key reversal to the right is also a good one, in that volume expands along with the trading range. However, it is not preceded by much of a rally and would not, therefore, earn as many stars as the first one. Exhaustion bars develop after a really sharp up or down move. They are a form of key reversal but differ sufficiently enough to warrant their own category. The requirements for an exhaustion bar are as follows. 1. The price opens with a large gap in the direction of the then prevailing trend. 2. The bar is extremely wide relative to previous bars. 3. The opening price develops in the lower half of the bar in a downtrend and in the upper half in an uptrend. 4. The closing price should be both above the opening and in the top half of the bar in a downtrend, and in the lower half and below the opening in an uptrend. 5. The bar is completed with a gap to the left still in place. Examples of exhaustion bars for both the top and bottom are featured in figures 10.12 and 10.13. They differ from the one-bar island reversal, in that, while there is a gap to the left of it, there is no gap between the exhaustion bar and its successor. Examples of one-bar island reversals are shown in figure 10.14. What we are looking for here is an extreme movement in the price that is preceded by an already strong move. The idea is that a bullish bar following a sharp decline opens with a huge gap, but closes above the opening and, ideally, more than halfway up the trading range. This reflects the concept of a reversal in psychology. The large gap and wide trading range also point up the kind of frenzied activity associated with a turn. The opposite set of conditions would be present for a bearish exhaustion bar. Chart 10.10, featuring the 2012 price action of Ruby Tuesday, shows a classic exhaustion bar with the price gapping down sharply following a waterfall decline. Then it closes well into the upper half of the bar, indicating that the sellers were no longer in control. The huge volume also contributed to the idea that an important change in sentiment had taken place. You will find that gaps almost always develop on the intraday charts at the open due to some overnight change in psychology. This means that exhaustion bars tend to be more prevalent in these very short-term charts. Pinocchio bars. Exhaustion also shows itself in forms that are different from those we have so far considered. I call these Pinocchio bars because they temporarily give us a false sense of what is really going on. They are bars in which the bulk of the trading takes place beyond a support or resistance zone, but the open and close do not. Often, this means the false move takes the price beyond a previous trading range, thereby giving a false impression of a breakout. The character Pinocchio tells us when he is lying because his nose gets bigger. In the case of our Pinocchio bar, it is the isolated part of the bar above the open and close, or below them for a bullish bar. That is the big nose that by the end of the bar signals a probable false move. Figures 10.15 and 10.16 offer two examples of false upside Pinocchio breaks. Figure 10.16 indicates that when a false break develops above a downtrend line, this is indicative of exhaustion since the price cannot hold above the strong resistance reflected by the trend line. Marketplace examples of Pinocchio bars are featured in charts 10.11 and 10.12. The first shows a break above the trading range, which was nullified by the time the bar closed. The second shows a false break to the downside. As so often happens following whipsaws, the price moved in the opposite direction from that indicated by the break. The outside bar in the left part of chart 10.12 offers another form of Pinocchio bar. One important fact about an exhaustion move is that the extremity of the move often proves to be an important support or resistance point. In that respect, It is often a good idea to place a stop loss a little bit beyond the extremity of the Pinocchio bar, provided, of course, that still results in a reasonable risk-reward. Summary. 1. 1 and 2 bar reversals reflect exhaustion and usually signal a reversal in trend. 2. To be effective, these reversals must be preceded by a worthwhile move. 3. Their trend reversal significance is only of short-term duration. What constitutes as short-term will depend on the time span of the bar or bars in question. 4. Daily or weekly reversal patterns will be far more significant than those appearing on intraday chart. 5. Reversal bars that contain more of the required characteristics normally provide stronger signals than those that only have a few.